Good morning, everyone. We are live on YouTube at this moment. We will start in, say, 10-15 seconds. Be with us. Hemant, you want to start?
Yeah. So, good morning to all, and very warm welcome to all participants. Myself, Hemant Mehta, ThinkTank Multidisciplinary Global Platform Chapter Leader, welcomes you all to ThinkTank Global Conclave for India Growth Story and Meet the Expert Series, covering in detail all the management think tank, valuation think tank, IBC think tank, financial reporting think tank, RERA, then FAFT, ISA, and capital market think tank. It is presented as a part of think tank at the rate Vivek Patra. Vivek in Sanskrit means knowledge and wisdom. Patra is a innovative news updates containing slides and slides on sharing latest development and real estate life examples by CEO, CXO, CFO, specialist, and professional with global experience. Today we have ThinkTank Multidisciplinary Global Platform special meeting for all stakeholders in finance, corporate affairs, industry, and professions. ThinkTank has become in existence since over a decade. Idea conceived somewhere in January 1991 to have conferences, conclave with CEO, CXO, CFO, panelists, and specialists sharing experience and real-life examples. Our panelists are finance leaders working in reputed companies or professions since many years and have deep domain knowledge. ThinkTank platform now digital has got overwhelming response globally on digital media and expanding rapidly through LinkedIn, Facebook, etc. Our participants and experts have rich experience in industry and profession, who have done CPA, CFA, CA, CS, CMA, ISA, DISA, IFRS, BTech, Masters, PhD, etc. All professional study. Majority they are all professionally qualified. Sharing experiences, knowledge, and wisdom. By you can reach out. You can reach out to us through our website www.thinktank.co.in, and you can share your experience and knowledge. Due to overwhelming response to our annual report, corporate strategy, and ESG, we have announced 6P awards and recognitions. 6P stand for profit, people, planet, professionals, promoters, and platform. For corporates and annual reports, analysts, professional, achievers, CEO, CXO, CFO, with a very respected jury, with rich experience in interaction with stakeholders and boards. Their recognition and award would be announced with a rigorous process of scrutiny and choice and interaction with the participants. As participants, we are aware. Recently, we have launched a much awaited newsletter called as Think Tank at the rate Vivek Patra, India Growth Story, a comprehensive conference material compilation over 600 pages, sharing experiences by CEO, CXO, CFO, specialists with latest development and series on blocking regarding regulatory fraud, then financial reporting, Ind AS, IBC, taxation, digital capital market, technical analysis, ISA, bank, audit, corporate affairs, and would be available for subscription. And any ethical contribution by well-wishers are welcome. We will also be covering important and latest development as suggested by many participants in coming weeks. Example, valuation and financial modeling, health is wealth, cyber security, blockchain, MSME, latest regulations and development in various important and professional bodies and institutions, etc. We request all to subscribe to ThinkTank YouTube channel for watching summits, conclave, webinar, and join, connect, and network on ThinkTank webinars group on LinkedIn and Facebook pages, Telegram channels, and specially created on suggestion of many participants and panelists. We once again welcome all members and panel share, and I would like to specially thank my colleagues in the digital global team, Anupam, Aditya, Ajay, Anurag, Archana, Ashwari, Dushyant, Mitesh, Mihir, Malvika, Manish, Nipun, Pramod, Praveen, Rakesh, Rucha, Pramod, Arkanan, Santosh, Subrat, Snehal, Sandeep, Sanjeev, Umesh, Vijay, Vikas, Vikram, Yogesh, and others for regularly contributing to ThinkTank. Today, we have an excellent ThinkTank multidisciplinary platform summit, eminent stalwarts and specialists sharing experiences and latest developments. Let us make it interactive event. And I just request Manoj to take over further.
Thank you very much, Hemant bhai. It's indeed a pleasure and privilege for me to be all with you today. Lots of developments happening practically every day, and many results are coming. This is a result season, so we all need to do a very, very deep dive and understand the reporting, the results, the performance reviews, what goes behind it with an eagle's eye, and going to look into various aspects, because the results show for a person who does a deep dive often what can be beyond it. Good results are rewarded, wealth is created, bankruptcies also happen, frauds happen, how they are reported, what type of developments are taking place, what type of new developments are happening. So this is a new world. On the geopolitical side, there are lots of changes. So results are reflecting that. Guidances are being given accordingly. So there is a lot of uncertainty ahead, while regulators and reporting require more and more certainty. So nice to see wonderful deep dive presentations. Mr. Ramaprasad is here with us. Excellent experience in reporting, a couple of decades. Nilanjan and many more experts sharing knowledge on deep dive issues. Mr. Ramaprasad?
Yeah, thank you.
Ready?
Yeah, I'm ready. I think I'll have to share the screen.
Yourself and start the presentation.
So I'll have to share the screen also. 1 second, I'll just share the screen. Yeah, you'll have to bear with me for a second. Yeah. You're able to see, sir?
Yes, sir, we can see it.
Oh, okay, fine. Fine. So I'll start with the, yeah, thank you, Manoj. I'll try to make it sweet and short. About myself, a fellow professional like all of you, every day learning something in the profession of auditing. It's very vast, I would say. So beyond it, I have nothing to say, excepting that I permanently remain a student of this wonderful subject called auditing. And every day it is a new experience. Every day it is a new learning, making us truly, I would say, knowledge seekers, which is, I think, the mantra of every fellow chartered accountant. With those words, I would probably comment this presentation. Thank you, Manoj, for this opportunity. And I must thank the sincerity and the dedication which the whole group is doing this on a weekly basis. Without any break, and that's something amazing. So with these words, let me just, this new summary of the new reporting requirement under 11E and F of the company's auditors rule 2014 has come, and they are probably say a mass the way it's going to impact us. Nobody still knows the impact, because once the reports come out 2 years later, how the regulator is going to look at all those things will be going forward. This is an amendment which has come and given by the MCA and effective for audit reports from April 1, 2021, for which the reporting will happen on 31 March 2022. So what does the rule state? Basically, the background of this, if I were to probably summarize it, is the sort of number of frauds which have been happening across the companies, be it Dewan Housing, ILFS, whatnot. And one of the key things which the government noted was the siphoning of funds. Everywhere the funds were routed, layers and layers of companies were created. The funds moved freely between one to another, giving the regulators, auditors, stakeholders, everybody a nightmare as to who was ultimate beneficiary. Where is this fund going out? Is it going out of the country, etc., etc.? So to probably obviate that and to bring more sanity into the whole thing, parallel requirements have been given both in disclosures, a requirement for the FS to be prepared by the management. Equally, and responsibility is also being cast on the auditors. And the auditor's responsibility goes beyond stating that other than what is disclosed, have you done any audit procedure, which essentially means that I cannot take any more shelter. And this paradox between are we a watchdog or a bloodhound will continue to hunt us. But I think with this new rule, I would tend to think that we are expected to be more of a bloodhound than a mere watchdog, and probably look at the things with a greater level of skepticism than what we've been used to. So probably this is what the background is and the context, so that as we dwell into the presentation, it becomes easy. See, I have also done a lot of reading from the implementation guide, and I've tried to condense a couple of good articles which came, and try to condense and put that in the context so that it becomes easy for the users, and also whatever we are going to discuss. The rule states there are three parts to the rule. The rule states whether the management is represented to the best of its knowledge that other than as what is disclosed in notes, no funds have been advanced, loaned, or invested, either from borrowed funds or share premium, or any other source, or kind of funds, or any other source or kind of funds by the company to or in any other person or entity, including foreign entities, which are called intermediaries, with the understanding, whether recorded or in writing or otherwise, that the intermediaries shall, whether directly or indirectly, lend or invest in other persons or entities identified in any manner whatsoever by or on behalf of the company ultimate beneficiaries, or provide any guarantee, security, or the like on behalf of the ultimate beneficiary. I think this is pretty much massive in terms of the scope. That the earlier where the current asset schedule were looked at, probably we cannot now look at a loans schedule or advance schedule just like that. We probably have to go in depth into it and figure out what's happening. So management has to give a representation that other than what is disclosed in notes, all this there is no movement of funds which are for any ultimate beneficiary which is routed through an intermediary account. So that's the first point. Similarly, this is as a funding party. This is what is called as a funding party. The second section says whether the management has represented that to the best of its knowledge and belief, other than as disclosed in the notes, no funds have been received by the company or from any person or entity, including foreign entities, funding parties they are called, with understanding whether in return or otherwise, recorded or otherwise, that the company shall, whether directly or indirectly, lend or invest in other persons or entities identified in any manner whatsoever by or on behalf of the funding party, which are the ultimate beneficiaries, or provide any guarantee, security, or the like. So whether you give money or whether you receive money, there is a huge reporting obligation. And then the third aspect says, the rule says, based on such audit procedures that the auditors consider reasonable and appropriate in the circumstances. I want to pause and invite all of you to this very, very generic phrase, reasonable, considered reasonable and appropriate in the circumstances. I can tell you that this is going to be extremely litigative. This is going to cast onerous responsibilities. And we have to use every single judgment capability available with us, including our documentation skills, our auditing skills, to ensure that we are ready to face any potential litigation on this account. So when we are doing the work itself, I think we should apply that hat of skepticism and ensure that we are fully covered. And then say nothing has come to their notice that has caused them to believe that the representations contain any material mistake. So the aspect is management will give a representation on these accounts, and then you have to not merely accept the representation, but to work on this representation, do procedures around them, and you just cannot get the file it in the audit documentation when say that you have done work. Then that will not be considered as reasonable and appropriate under circumstances. You need to probably do a lot more work. Definitely the presentation try to capture some of those aspects, which includes confirmations, preparing T-shaped accounts to figure out how the funds have been routed, to find out whether any other source is there where we can figure out. So a bit of a roving inquiry, a bit of a, I would say, a blood down type of work has to be done. Moving on to the next aspect. The rule states, another rule 11F states that whether the dividend declared or paid during the year by the company is in accordance with Section 123 of the Companies Act. So this is, I think, much more straightforward. And so this is the amendments in Schedule 3. The company receive funds, invested funds, directly or indirectly lend or invest. This is what I covered. Ultimate beneficiaries provide any guarantee or security or the like. I'd like to pause for a moment on the word the like. It includes letter of credit. It includes comfort letter. It includes any form of communication to any other party which can be legally interpreted as a guarantee. So this is very, very clear. It need not be a straightforward communication. It need not be a straightforward corporate guarantee. It can be anything which, in the eyes of law, tomorrow could be construed as a guarantee. So that's something that I want to caution our fellow brothers, that this is something that we ought to be very careful. Somebody will say that this is nothing but a letter of comfort given in the letter of the company. But in all fairness, the counterparty or the advocate who's on the other side can easily represent it, can easily make it out to be a guarantee. And then, we will have to really protect ourselves. And if you don't give a disclosure and say that everything is all right and that nothing has come to our knowledge that causes to believe that the representation is materially misstated, then I think we are actually, having a difficulty there. So this is something that one has to understand. So this is the amendment. The disclosure is required.
One question in regard to this.
Yeah.
How, as an auditor, you come to know if there is an informal communication or some guarantee bond or something which has been signed by the director during the course of business, where it implies to be a guarantee or something by the corporate?
Absolutely.
So how can you come to know about it without any proper, you might have gone through the proper documentation, all these things, but there are certain documents which are not shared with you at all.
I think very well said, very good query, Manoj ji. Let me answer this as an auditor in 2-3 aspects. The first thing what I would do is definitely, whatever documents they have placed it before the board, because these transactions normally, it's a good governance to go through the board. I will definitely take cognizance of it. Second, a company secretary, whatever, documents, the minutes, etc., go through it in depth to see any other document has been, minuted as being issued, etc., etc. I think we can, as you rightly, definitely we cannot be held responsible if there is a complete fraud. We cannot, that is a separate exercise, but I am trying to answer this question.
My question is with regard to the, blanket permit to certain directors As in when you required to obtain any finance, you can sign the document and you can, accordingly the company can take the finance or
Absolutely.
something like that.
Yeah, absolutely. I think there, Manoj, my experience, I had this experience where omnibus power was given to a director to open, to type resolution, sign it, and open bank accounts, etc., etc. And the governance which was missing was that whatever was done by the director because of this power, he has never reported to the board. So if you really ask me, if such were the power which are given, I would recommend that, that the board also passes this resolution, whereby such acts where the director has done so moto because of the power given to him by the company should also be reported by him as a matter of good governance to the board. And if there is nothing, then the board should also say that these are the acts which have been reported by the board and nothing more. So that the board also is covered, we are also covered, because there is nothing else we can do. And if there is something fraud done by the director, there's nothing that we can do excepting wait for the regulators or the to probably take cognizance of it at a later date when it blows up. Yeah. So that's probably the only way we can do. So your entity level control risk matrix should bring this point as a control and then put it, because that is the most reasonable form of controls that you can put it in the company to ensure that the board is covered, company is covered, and you are also protected as an auditor. Yeah.
Ram, can I add something?
Yeah, Nilanjan, please, by all means.
Yeah. So I think Hemant did raise a very pertinent question. That if informations are not being shared, or let's say there are certain very overreaching powers given to a particular person, right? So Hemant, I think the ICI was seized of this matter, and when they came out with this guidance, especially in the light that this particular reporting requirement will cover all understanding, right? Be it written, be it oral, be it any form, right? So I think they were very clear that auditor in their rights under the Companies Act in no way will be able to get to those situations which are not documented.
Absolutely.
Right? So they can perform inquiries, they can take representations and all that, but ultimately there has to be someone who has to take the ownership to say that there is nothing other than there is in the financial statements. So in that regard, the guidance by the ICI is very clear that the board has to take into record that other than what is there in the financial statement, there is no other oral or non-written agreement or non-written understanding which has been entered into, right? But having said that, I do appreciate the point which Ram was making, that this would involve attention, right, from various facets of stakeholders, not only from the ministry but also from various parties, be it the one who is rating instruments, or be it in the one who is as us, like professionals who are looking at the financial health and governance of the entity. So this, in my personal view, would be a very key area where the focus of the all stakeholders will ultimately go to.
Thank you, Nilanjan.
Yeah, thank you, Hemant.
So I think that was excellent observation by Hemant and Nilanjan, and that's exactly the point, Hemant ji, that that is why you need to have a very good board and all those things. I would tend to think that this will force companies to make it better. And on a more, I would say, subtle note, this is probably aimed to really capture those web of companies which are created by various individuals, be it who are having connection, who are actually in public life, who are well connected, who are trying to do transactions, but trying to give it a legal cover, which is probably something that we have to be very, very cautious of. I wouldn't want to take names being a public forum, but there are enough and more going on in public fora in various states. We would call it the web of companies promoted by people who are close to power, etc., etc. So that's something that one has to be cautious of. Moving on to the next slide, which is 6. The company shall disclose the following: date and amount of fund advanced, loaned, or invested, received from funding party with the complete details of each intermediary, amount of guarantee, etc., Declaration. I think these two are very critical. Declaration that relevant provisions of FEMA and PMLA are not, are complied with, and there is no and they are not violated with respect to acts. This is probably something that the company should be very, very cautious and take care of that, because ultimately they have seen that the money has actually moved out. And as I explained in the beginning, that this is the purpose of the new disclosure requirements, that corporate frauds is a diversion and siphoning of funds. The shell companies were used for laundering, difficult for regulators, auditors to track money, trail of these illegal funds diversion, transparent disclosures of onward lending and investment of funds. I think if I were to pause and really, look at it from a pure auditor's perspective, if I were given the current assets schedule today, each and every item must be scrutinized and see what is the relevance of that advance or that loan, etc., to the business. To is it a capex advance? Is it advance for supply? Is it advance for anything that acquisition? Anything by whatever name it is called today. One has to really look at it. Earlier, we will just take judgment calls on it. Today, this is also getting into binary way of auditing, yes or no. So the judgment is probably not going to be there. So a lot more work is going to be there. And I think this is something the auditors, the fraternity should be very careful. These responsible disclosures also cast a responsibility managements to provide adequate information about the nature and extent of such transactions. One good thing is that there is onus heavily on the management to give the disclosures, which essentially means that we are not alone. The way we have been targeted, probably we will no longer be targeted like that. We definitely have to take the management along with us. And as Nilanjan rightly said, the board should definitely take a detailed cognizance of various transactions, including non-written, any oral understanding, and take a represent each of the directors that they have not indulged in any such act, which ought to have been otherwise disclosed in the financial statement. So I think that's a background and that's a backdrop of this, which was explained in the beginning. What are the management responsibilities? Now, if you put it in we call it a step and ladder approach. I just we made this presentation. Disclosure in financial statements, obtain end-use certificates from parties, obtain the balance confirmations, and to provide management representation to auditors. I think so. That those are all straightforward audit procedures. And my humble submission to the professional brethren is that do not sign the accounts till you get your complete documentation in respect of these transactions, because by and large, generally what happens, because of pressure of time, there's a practical issue. Management will tell, I'll give you tomorrow, I'll give you day after tomorrow, etc., and you'll be forced to sign. All in good faith. There is no lack of any good faith there, but do not sign unless you get these papers, because once you lose control it's very difficult to get that sort of control after you sign. So that's something that I'd be very cautious and warn and caution our professional brothers. Yeah. The setup of implemented adequate controls to ensure the risk relating to assertions of existence, rights and obligations, etc., are properly addressed. I would tend to think that I would definitely like to look at the ELC there, how the ELCs, RCMs have been drafted, probably strengthen them around the same, take as rigorous procedures, put all these things on quarterly controls, get these controls, duly checked with the auditor on I'm talking from listed company perspective on a quarterly basis. Ensure the internal auditor also does it, and also when secretarial audit is also there, ask them to look at it. So 3 eyes look at it so that nothing is missed out, and to ensure that IT systems are updated for any additional information, etc. What are the management response? Proper documentation. This is what we are telling. Way of written agreements, careful evaluation of the nature of the transactions with another person, very clearly evidenced and documented source of funds, and evaluate if the ultimate party receiving the funds on behalf of the funding party document with adequate evidence. Audit committee are required to approve such transactions, which is what Nilanjan was making a mention, and that's something that is a big cover for us. And the recording by the board that there exists no oral agreement, etc. And when the funds are not intended to be further passed on, the agreement to specifically prohibit further onward lending or investment. So I think this is something, a new class which one can definitely put in those agreements, so that it is not it protects the company and also protects the party to whom the money has been loaned, because there could still be transactions between companies at arm's length with the interest rate which could be better than the market, and it could be a prudent business decision taken by the board with full knowledge of facts. Probably this class in such agreement should be of great help to the board so that the money can safely come back. The compliances needed by auditors for audit reporting requirement. I think design and perform audit procedures as considered appropriate and reasonable. As I was telling you, this is something that we have to, keeping 3 papers representations is not sufficient. We need to really write and figure out and create, document what procedures we have done. Could be, as Nilanjan rightly said, inquiries, discussions, minutes of meeting, etc., to ensure that we are fully covered and without any passage of time, whatever procedures which we have done, which we are considered appropriate, to ensure that we are documenting and putting it in file so that nothing is missed out. Representation of management to be obtained, and the audit procedures include, as has already been told, end-use certificates, understanding timing of cash flows in the absence of written agreements, arrangements, review of advances received, long overdue balance with no history of sales, services, or any other business-related transactions, and professional skepticisms, has to be very, very high. And your aging shows 2 years, money has not come back. Then you figure out, get the confirmation, try and get the balance sheet, download it from website, see where the money has moved. If you see money movement has happened from that beneficiary's account to some other party, begin the start the chain of transactions, figure out where the chain of transaction leading to ultimate beneficiary, which could be different than what you could have reported. So then you don't wear the auditor's hat anymore. Probably you'll have to put up a bit of a forensic auditor hat on you and then probably look at it. So I think this is something that I would tend to think should be done by an experienced auditor, maybe a manager level person, or in case of Mehta, from the partner himself should be looking at it very, very closely to ensure that there's no exposure to him or to the organization or the firm that he represents. Yeah. The audit assertions with respect to classification, occurrence, rights and obligations. Then underlying agreements to be reviewed. Funding is on a pass-through basis, and select samples for verification and reviewing the minutes, which are all, I think, straightforward audit procedures, and obtaining confirmation from third parties, onward lending, investing, etc. The audit of funding party, check if funding is being made to an intermediary for onward lending, etc. Audit of an intermediary in case it's gone to an intermediary. If you have a doubt, you want to protect yourself, I would tend to think I will get an agreed upon procedure done on the intermediary, get those reports, put it in my file to demonstrate that I've indeed applied high level of professional skepticism and judgment in my audit process, and to perform alternate audit procedures in case of non-receipt of confirmations request, to perform alternate, which could include audit of intermediary, some inquiries, some tracing of information, the public domain. You cannot obviously go to any other thing, but whatever is in public domain. So probably we have to apply heightened level of judgment and skepticism in this regard. This, I think, probably would be the procedures which are to be done. The other aspects include evaluation and testing of ICs, the internal controls. I would look at it both from a design perspective and also the operating effectiveness perspective, and to have better balance in controls in the systems and software, and probably look at things as routine as segregation of duties. I think that's something that in my practical experience, I have seen tremendous amount of management overhead of controls, where the MD had a sweeping power to pass, approve, clear, pay. He could also originate a journal entry. So the MD had an omnibus power to do everything, right from transaction initiation on to payment, which is probably not a great internal control to have, because there are no checks and balances, although maybe the MD. From a company standpoint, it is a huge design deficiency. And of course, that culminated in a definitive fraud. I think that's something that we as auditors should be wary of. And at the beginning, as Hemant rightly mentioned, we also probably need to look at the security audit aspect of this. And even today, I find in many companies, the segregation duties remains still a huge challenge. Password sharing still remains a huge challenge, and the segregation duty remains a huge challenge. And people ultimately you find that the lapses in the control happen only in these normal things, which we normally presume is already taken care of. Then the transactions recorded in the books to be compared to the disclosures and the details in the ratio maintained in Section 186 of the Act, and of course review the advances. I think these are probably the procedures which are on an elaborate basis. Advances given to parties disguised as loans. So this also is something that one has to be cautious, which means that each and every line item should be ticked, and you could use probably a combination of key item testing and your materiality levels can be fixed. If there are transactions deliberately going in lower amounts but on a regular basis, I would tend to think I would be skeptical as an auditor, aggregate it and then look at it as a whole, rather than each of them as a low value transaction. All techniques could be tried by the managements to obviate and overcome any rule. So we have to keep on improving our own procedures and our on the feet ground thinking to ensure that we are covering. So this, I think, probably would be the broadly the session I wanted to bring this to the notice of the fellow professionals, and happy to take any questions, have discussions on this, and leave this forum to add to whatever thoughts we have put it. Nilanjan, Manoj, Hemant, over to you people. Yeah.
A few observations. In fact, I would like to have the views of Ramaprasad and Nilanjan also. What would be the impact? Lot of structuring, corporate structuring is done with layering. Obviously, to camouflage the transactions.
Yeah.
This type of comprehensive disclosures. What is likely to be the impact?
Nilanjan, you want to take that question?
Yeah. So, Manoj, I think on that layering thing, right? First, I wanted to tell you that under the Companies Act right now, right, there is a limit up to which you can create layers of entities.
Correct.
Okay. So what has happened is that probably I think 5-6 years back, there was an amendment in the Companies Act which said that any company in India cannot have more than 2 layers,
yeah,
right, of companies. Okay. So what it did was that this rule or this requirement became effective prospectively, and any structure which existed prior to that was grandfathered. So those structures were permitted, but after that amendment became effective, you cannot have more than 2 layers of entities. So I think that is a safeguard which the ministry has built. So this particular amendment was quite debated. It came in public news also. Initially, what ministry felt was that that the corporate environment is maturing enough, and they didn't want to make this provision effective. But because of, again, certain setbacks, they thought of making this effective. So Manoj, to answer your question, there is first of all a safeguard which is there in the Act itself. Number two, if they still have a layer, right? First, we need to see whether those are within the permitted number of layers or not. Okay, let's say I have 2 layers permitted. Do I have the third layer? If I do have a third layer, then there is a very big question on the governance of the entity itself. The transaction that you have made or the investment that you have made on the third layer itself would become invalid. It will become invalid at the inception itself. In the normal parlance, we call it void ab initio. Right. So the in the financial statements, you will have an invalid transaction sitting in the financial statements. It will then trigger whole sort of implications. For example, you will need to impair, you need to write off, all those things will be there, right?
Fine, thanks.
Yeah.
Would anyone like to add?
Manoj, I would like to add here is that, in IBC also we came across so many cases. For example, in case of Videocon oil, I can say there were, more than 2 layers initially, because the amendment was not effective from that date. So it was a very old case. So, it was a Cayman company, then Cayman company was holding in some other company, and then other company was holding some shares in the, in the country in which the oil wells and everything is located. So assets of the company is located. So probably, in IBC, during the implementation of IBC, there are many reasons which has come up in front. And because of one of the factor is IBC, where, due to forensic audit or due to the specific audit, a certain point has already come up. And that in this new Companies Act, they have tried to plug it by way of making this amendment.
Right.
Hello.
Yeah.
Hemant bhai, thanks for sharing this Videocon examples. That's many companies actually, they have done this and have been caught over a period of time. And new requirements because of that have made it stringent. But of course, it is causing a little difficulties for genuine companies. Like we remember when Tata Chorus acquisition took place in JLR. So layering were required by the necessity of funding transactions.
Correct.
These were huge. The bankers and currencies were different, and requirement was immediate, and ingenious structures were did, which was necessity. Of course, in the long term, they have created very good wealth. And in ILFS Videocon, different type of structures were used. Santosh?
Yes, Manoj.
Yeah, Santosh, I would like to have your thoughts. You have been doing deep dives for a long time, and now there are new regulations, very stringent requirement coming. So it is helpful for the stakeholders. But what do you see the future of corporate structuring and for various type of transactions, whether from the promoter angle or from the financier angle, and also there are offshore funding entities also, not from the assurance point of view, but from the structuring point of view.
Yeah. So very good morning to all of you. I just joined the conversation, so I'm just trying to catch up with everyone. So Manoj, my thoughts are as follows. As far as structuring is concerned, corporate structures, ever since the new Companies Act has come into effect, and ever since, since last few years, media has also become very savvy. Therefore, what could have been done maybe 10 years back is now, not very easily possible. I wouldn't say it's absolutely impossible, but it's not easily possible. As far as offshore units are concerned, and various there are various tax havens, Cayman Island and some of those places. Yes, I mean, if you look at the way even internationally the regulations have evolved, as far as even the international taxation has evolved, things are not very easily, you cannot do things very easily now. Of course, every now and then we come across instances like, for example, in Jet Airways, where they had a Mauritius based arm, and it was the listed company was paying some heavy consulting fees to some company which the Goel family was interested in, or even in APG shipyards for that matter, where they had paid. There was this Surat-based company within the group which was carrying out some, if I recollect, some EPC contracts, and there were some payments to Mauritius-based contractors, so to say. So those things we keeps coming up, but now because of media, attention, and analysts have also become much more aware. And then there are proxy advisory firms also, which kind of put pressure on the corporates to do much more than what is required. So I think as we are going ahead, I think things are looking difficult for such structuring. But having said that, new ways would keep emerging.
One interesting real life examples of structuring which came out, a very neat and clean transaction. That is a ACC and a wholesome deal. It happened. It just came in India's way, and a very large corporate could take advantage of it. But here also, structuring is a multi-billion-dollar deal. So international structures were used. And of course, it was the necessity, the foreign stakeholder trying to do the deal. They wanted it that way. And ultimately, all this reporting, when it comes, it will help us to understand the structures.
Right.
To add what Santosh said and Nilanjan said, the market also discounts any innovations in the financial statements, and nowadays looks for something very straightforward and simple. If you really want to have true market value, I think better to be straight and simple. And that's been my own personal experience for the last 30 years. I mean, classic example that we all should learn lesson continuously is Infosys.
Yeah.
I mean, that's a fantastic example of how you can keep things very simple, go through some aberrations, but put your things back, and then the market actually rewards it in a massive way. And it still continues, the four biggies, the IT still continues to be the benchmark companies in terms of anything, whatever you can talk of. So I think that's something that innovation no longer market will agree. And I think the best way to advise and keep on encouraging corporates is to make things, more and more transparent to them. Tell them that this is how it is. The value realization proposition is much better with cleaner, balance sheets and cleaner notes on accounts. That's something that we should keep on advising and
No, absolutely agreed. In fact, as Ramaprasad speaks, I recollect one instance, Manoj ji, a couple of years back. Of course, this was before the COVID, broke out. There is this large listed pharma company based out of Mumbai, which had some real estate. Okay, they had their office in South Bombay, and then therefore they wanted to monetize the real estate, and they had shifted anyways the corporate office to somewhere around Lower Parel, and they formed a trust. Okay, and the trust, so because basically they wanted to get the best out of the deal, they formed a trust, and then there was a put option given to the real estate company, which was eventually going to buy it. It was a very complex structure. The intentions apparently were very clear, but then obviously they had taken a legal opinion from a top legal firm, and one of the top consulting firm had also advised them and all that. So legally it was absolutely, intention was there, legally it was okay. But just to kind of, as Ramaprasad says, apparently on structure it looked very dodgy, although their intentions were to optimize the tax exposure. So therefore, I remember it made the news on front page of the Economic Times, and it came out as though things are not very clean. So it's very important to, I mean, what he said, market also discounts these things these days, however good your intentions may be. So I think that's another thing.
Excellent presentation. Can we move on to the next topic? Santosh, you would like to take a few results, or we can have another?
Yeah, sure. Why not? Can we just start with Bajaj? I have, so I've picked up a few companies for today. I picked up 2-3 pharma companies and 2-3 NBFC company. So I'll start with this Bajaj and Manojji, I'll need a 10-15 minute break in between, and during which Nilanjan or someone else can fill in, and then I can of course join when he is done, because I have a short call to make after some time. Is the okay? So my shared screening seems to have been disabled.
Let me try and allow that, Santosh. Just give me 1 minute.
Sure. So just to, while Nilanjan does that, just to, few things that caught my attention, and, since last few days, as far as financial results are concerned, is a few pharma companies, had some impairment issues in the operations in the US. We know that US is a very significant operations for Indian pharma companies, and US pharma market is one of the most lucrative, market. So most of the top Indian companies do have presence in US and do have significant, profits coming from the US markets. So NATO Pharma had impairment of on account of some of their businesses which they are discontinuing in the US, liquid businesses. Also, Torrent Pharma had impairment. I think a lot of investments had gone in anticipation of the COVID, drugs, and therefore this is like, unfolding of those things. But that was one of the discussion points that, at least that caught my attention. As far as the NBFCs are concerned, I think things overall, if you look at the top companies like Bajaj and Mahindra Finance and L&T Finance, they have only increased their loan books. The stress on account of COVID-19, that was, the pessimistic outlook that most of the NBFCs were taking as far as provisioning is concerned, management overlay and all, most of them have, many of them have reversed it. Of course, Bajaj has kept it intact. 800 crores is still the management overlay for, ECL provision. But things are looking very good for top NBFC companies. I think Nilanjan has shared the screen, allowed me to. Is my screen visible?
Yes, Santosh.
It's coming, I think.
Yes, it is there. Yeah.
Yes.
All right.
Yes, you can see.
So let's take up this Bajaj Finance. Core asset. So FY 2022 Q4 highlights. Core AUM, that is asset under management, is 1,92,000 crores. So you have a growth of 26% year on year, which is phenomenal. I think their monthly disbursements since last few months, since last 6 months particularly, has significantly gone up. And especially on account of mortgage. They have given the breakup of their loan book also in one of the subsequent slides. Operational expenses to net interest income. That is, this is more like, a kind of, operational expenses as a percentage of net in, the gross profit, that is NIM, net interest margin. So 34%, which is again very healthy as compared to last quarter of last year. PAT is 2,400 crores, year-on-year growth of 80%, a return on equity of 5.7%. Net NPA, so this is again important. Net NPA, this is as per the RBI norms, of 0.68% as against 0.75% last year, in the Q4 last year. Again, very healthy net NPA. Generally, the best of the NPA, the best of the NBFCs have net NPA in the range of 1.5. So this is almost half of it, which means that even the asset quality has also, improved. Not just the profitability has increased, but even the portfolio quality has significantly improved, which is good sign. Strong core AUM growth of 10,000 crores in Q4. AUM growth was secular across all lines of businesses. So they have various verticals, various types of loans. We will see that breakup later. The company has added 39,000 crores of core asset under management. AUM was up by 29% at 1 crore 97,000 crores against 1 crore 52,000 crores last year. Again, significant growth. I think a lot of disbursements have actually happened after the festive seasons during October, November, December. In Q4, the company booked 6.28 million new loans as against 5.47 million loans in Q4 last year. In FY22, new loans booked were 24.68 million as compared to 16.88 million in FY21. So again, monthly disbursements, not just the number of disbursements, even the quantum has significantly grown. In Q4, volume growth of B2B consumption business was 15% and disbursement growth was 27%. Again, they have also beaten the market amongst all the NBFCs. I think 27% disbursement growth is very, very, very impressive. In Q4, the company has added 2.21 million new customers through its franchise. Again, this company focuses, while it has, and they have a couple of slides on this, while they want to have, a kind of a fintech kind of a platform for their disbursements, but they are also focusing on growth in the actual branches also, the actual, physical branches also. So again, hybrid kind of a strategy, rounded strategy. Customer franchise stood at 57 million as of 31st March 2022, a growth of 19% year on year. Highest ever customer franchise addition of 9 million in FY22. Cross-sell franchisees stood 32 million, a growth of 22%. The company is comfortable adding 8 to 9 million new customers in FY23. So again, very optimistic about growth in this current financial year as well. The company added 81 new locations. Geographic presence stood at 3,504 locations. So again, this is, very few NBFCs have actually pan-India presence. So if you look at the NBFCs geographical distribution in India, you have a few NBFCs which are focused in the south. You have few NBFCs which are more focused in west. You have, few north based, but very few NBFCs like Bajaj actually have, a pan-India presence. And I think that is one of the, big advantage, mainly because what happens is a regional impact also have a, have a role in the performance of a company. So for example, if you have, let's say, significant concentration in, say, Tamil Nadu, and let's say if you have, a flood or a cyclone in one of the years, then generally your asset quality, your delinquencies will increase. So it's very important to have a pan-India kind of a presence so as to have a bit of a hedge against all these, calamities and one-off events. Competitive intensity remained elevated across products. Company continues to protect its margin profile across businesses. In Q2, and this is again, point number 9 is also important here. In Q4, cost of funds was 6.71%. So which is again very, very healthy, because typically NBFCs, the best of AA rated NBFCs also would have cost of borrowing in terms of, around 7.5, 7.75%. So having a cost of fund at a 6.71% is very good and very healthy, because ultimately this business is all about lending. In fact, Manojji, I think it was Aditya Puri who once said that, lending business, in long run, the person with the least cost of fund is the winner.
Yeah,
so this is 6.71 is very, very healthy cost of borrowings.
Any idea, pausing for a moment, any idea, Santosh, what is our composition? Is it because of deposits, or is it money being plowed back? What could be the reason why it is so low? Is it, or?
No, last year, in fact, Ramaprasad, from experience in my own clients also, the cost of funding generally has gone down also. Even if you look at groups like IFL or some of the other ones also, Muthoot also to a great extent. So cost of funding for NBFCs generally has gone down. This year, of course, because of the rate hike, etc., which we have seen subsequent to March, and of course, the RBI governor has also given enough hints that there will be further rate hikes. This year, probably financial year, there will be slight increase in the overall cost of funds. But otherwise, their composition, I think, is mix of deposits. Deposit is actually more expensive as against some of the other funds.
Funding, yeah.
Yeah, they have raised funds by way of debentures. They have, in fact, also raised funds by way of market-linked debentures, which are listed. So that has reduced overall the the cost of funding.
I will supplement this, Mr. Ramaprasad. A very valid question, particularly for Bajaj Finance. The best savings for Bajaj Finance comes from raising big ticket money, big ticket, I would say hundreds and thousands of crores, which comes from commercial paper. Bajaj Finance is the lowest cost borrower today in the market, besides Reliance, in the commercial paper. When the RBI special dispensation for pumping liquidity during COVID times came, Bajaj Finance was among the first to take money at below 4.5%.
Oh, that's fantastic. That's very,
even today,
that's big actually.
Bajaj Finance is getting money below 5.5% in commercial paper. Now the figure we have is here, the cost of fund is quite low, below 7%. Now this is the average cost.
Oh, correct. No, absolutely.
Big ticket, thousands of crores come from even today in the rate hike scenario, up to 5.5% they are getting this. Of course, this short-term finance.
Yeah, that's the issue with commercial papers, Manojji, that while you can raise it at a good rate, but because it's short term and typically your loan book would be, middle term and long term, you also need a significant, bank borrowings or ECB borrowings also.
Correct.
Back it up.
So short-term rollover takes place. So it is effectively a quasi-permanent source of finance.
Yeah.
The CFO, the board decides we'll have so much percentage in structuring the total funding, X percentage from commercial papers. And
Correct.
they get rolled over. They have the high stating. And whenever this one can today save easily at 2% over the cost of bank lending through commercial papers.
That's
And
right.
on your AUM base, the 2% actually gives a huge swing to your profitability.
Absolutely, absolutely.
It's massive actually.
Absolutely, absolutely.
Good
It
point.
is massive, and which is why you will see, Ramaprasad, a lot of NBFCs now going for IPOs.
IPOs, yeah.
Because otherwise, at if it's anything sub AA, in next 2-3 years they won't be able to survive because of regulations as well as because of cost of funding.
Correct.
We know that in long run, because of all this Russia and all that, and RBI governor has also said this in recent times, interest rates are going to go up. So unless these people manage their cost of funding adequately, it's it's a survival issue actually.
And also the all the NBFCs keep chasing probably the same set of good borrowers, and that's exactly also a big challenge also. Yeah, it's also competition for the borrower as well. Yeah.
Interestingly, what came out just a few days ago, Chola Finance, one of the very high quality NBFCs in the south, they raised unsecured debentures at 9%. They got good money, but it's a mix, unsecured. Normally the secured borrowings have a lower cost, but they have a margining lending rate which goes even up to 13-14%. And for them, even unsecured lending, in which I think many banks also participated, 9% for Chola is very, very tempting for many lenders.
Right.
Institutional lenders.
The other thing is Bajaj Finance also does a lot of co-lending, Ramaprasad, which reduces the cost of borrowing significantly.
Yeah.
Which means that, they don't have the borrowings on the balance sheet. So for example, if I'm lending, say 10 crores, I originated together with another bank, and ultimately I'm left with a loan of 2 crores itself.
2 crores, yeah.
Because 8 crore eventually gets taken over by the bank. So instead of lending me and then me onward lending to the borrowers, this co-lending thing has got some traction amongst some of the top NBFCs these days.
Yeah, because banks are also unfortunately saddled with huge deposits. They also don't know what to do.
Yeah. They're also looking for avenues to.
They are also looking for avenues to place the money. Yeah, it's a good.
And for banks, it's more lucrative to do that. Absolutely.
Yeah. Please continue, Santosh. Sorry.
Santosh sir, can you just explain this co-lending one again?
Yeah, so Mr. Iyer, what happens is co-lending, there is a RBI co-lending scheme under which what happens is NBFCC, typically the idea is that what used to happen, NBFCs used to borrow money from banks and onward lend it to borrowers, right? That is typically how the model works. But then there is this co-lending structure where basically if I'm identifying certain borrowers of certain, credit, meeting certain credit parameters, which is agreed beforehand with a bank. So I'll need to partner with a bank, let's say an ICICI bank or a HDFC kam karta hai, but PSU bank or whatever. So then as an NBFC, I don't need to borrow from the bank and then do onward lending. What I can do is I can originate a loan and then 80% or 75%, the bank takes it over. So it's not a direct assignment. It's like a co-lending. Why? Because the MRR regulations do not apply here. The minimum retention requirement of the RBI doesn't, that doesn't need to be, complied with here. So since origination time itself, in a week's time or so, 10 din mein wo bank utha leta hai. So I get a check of 8 crores in my example. So again, there is a sharing for PF, whatever processing fees I would have charged the customer. And even in the loan agreement, it is known to the borrower that, there is another bank, let's say an ICICI or a Union Bank, which is also lending me. Of course, I need to, as a borrower, I need to repay to the NBFC itself. An escrow is started. So whatever the NBFC collects, it also gets allocated in the ratio of whatever is agreed, 80-20 or 75-25, and that is how. So from NBFC's perspective, what happens? Loan आता नहीं है फिर balance sheet में. So it helps from perspective of debt equity or capital adequacy.
I'll just supplement by way of a live example. Now, for example, HDFC has aggressive growth plans in funding houses, affordable housing. And Central Bank also has targets for affordable housing. India Bulls has customers in tier 2 and tier 3 cities. So HDFC Limited has a co-lending partnership deal with India Bulls Finance, and for a 30 lakhs funding, 20% is given by India Bulls, 6 lakhs, and 24 lakhs is given by HDFC, or it could be Central Bank, like they have 6 to 7 co-lending partnerships, and the company may source at maybe 8%, 9%, 10%. But based on the underwriting, they may get funding at 7%. So there is extra margin which goes to a company like India Bulls Housing Finance or Bajaj Finance.
Yeah, NBFCs make good money out of it. NBFCs make good money out of it. Why? Because the processing fees which they charge and what they pay to the bank as processing fees, there is a differential in it. So upfront, they make good money in this. Also, the other thing is in case of delinquency, the SARFAESI proceedings, it's again pro rata basis. So it's joint and several. So it is shared by the NBFC and the bank. Okay, moving along, Q4 OPEX to NII was 34%. The company continues to invest in terms of technology for business transformation. Again, this company is very bullish on this omni-channel strategy, where they want to. So they are basically trying to also come up with a fintech kind of a thing, a fintech platform, where in addition they can actually supplement their physical branches with online presence, metaverse, and all those other online strategy. So they have been, since last few quarters, they have been giving this, a write-up about this strategy. In Q4, loan losses and provisions were 702 crores. This includes an additional charge of 100 crores for one large B2B commercial account. So they have taken a one-off hit on one of the, of course, they can't divulge the name of the commercial account, but they have taken significant additional charge on one of the loans. I don't know where they had this exposure, but in one of the companies they have taken a haircut. In Q4, loan loss to average receivable was 0.38% on quarterly basis. This metric is now better than pre-COVID levels. The company has a management overlay. Now, management overlay is in addition to your ECL model. Whatever management in its wisdom makes an additional provision on a prudence basis, because you don't know, it's like a blind game in COVID. So, ever since COVID broke out, since last 2 years, most of the NBFCs have made an additional extra provision of ECL provision. That is called management overlay. Many of them have in fact reversed that provision because by and large COVID is now gone, but Bajaj has retained it. So the quantum is 1,000 crores as of 31st March 2022. In Q4, portfolio credit metrics and debt management efficiency across product improved further, and it is better than pre-COVID levels across most of the businesses. GNPA and NNPA stood at 1.6 and 0.68 at 31st March 2022 as against 1.73 and 0.78 as of December 21. So this is in fact better than pre-COVID levels. And as I said, this is one of the best in the business. Asset quality has also improved in tandem with the profitability. Stage two is basically where you have DPD of more than 30 days. Assets stood at 3,861 crores as of 31st March 2022, as against 5,200 crore, which is again a very good sign. So while the asset portfolio has increased, the loan portfolio has increased, but stage two has gone down as compared to last quarter. Likewise, stage three asset in ECL jargon is basically where you have 90 days overdue and basically your NPAs. So 3,133 crores as of 31st March 22, as against 3,108 crores as of December. So again, as a percentage of overall portfolio, almost 96.43% is stage one. Stage one is basically without any DPD or delinquency delays, or with delinquency not more than 30 days. So it's a very good, I think 97 is again one of the industry best for NBFCs. So very healthy mix of loan portfolio. So otherwise, I think nothing more to add. Obviously, the other businesses have also like Bajaj Financial Securities, because of at the back of the capital market growth is also doing very well. I told you that, you know, this omnipresent strategy update. So various groups have a significant digital focus now. We know that Tata Group came up with Tata Neo, you know, on its this digital platform, where it has aggregated all the, you know, online, whatever online presence. So likewise, this Bajaj is also having similar plans for its BFSI business, omnipresent strategy. So they keep giving updates about this. I think they are expected to go live in next couple of quarters. So phase one of the, I'm just reading bullet number 3, phase one of web platform will go live by October 2022. So next few months, this platform, you know, phase one will go live and phase two will March 2023. So many analysts are very, you know, optimistic about this, because this will enable them to compete with all the, you know, the Paytms and the Payus and the Bharat Pays of the world. So we'll see, we'll watch for this action. They also have QR based Paytm acquiring business has gone live. So again, all this digital initiatives, they are very gung-ho about. So I think that's, this is the structure that they give. The Manoj ji was talking about the corporate structure. This is the structure that they have, you know, published for Bajaj Group. They have Bajaj Holdings on top, and then you have Bajaj Finserv and Bajaj Auto, which is like 39% and 33%. And then you have Bajaj Finance, and then uske niche housing finance hai, securities hai, depository hai. You have the insurance arm, Bajaj Alliance, with joint venture with Alliance for both life insurance as well as general insurance. And then you have some of the other businesses, digital marketplace and healthcare ecosystem solutioning and all that. Yeah, I think.
Sir, एक second, can you go back to the previous slide? Photo लेना था, holding वाला.
हाँ जी.
Just a second.
Sanjeev Bajaj is now, I think, the president of CII also. I think a couple of last month he got appointed. So we'll see how.
Thanks, Santosh.
Okay, so anything to add, Ramaprasad or Manoj ji or Nilanjan? Any thoughts, any perspectives on this?
And come back to very high growth levels and efficiency collections has crossed pre-COVID levels very clearly. And if RBI hopefully encourages NBFCs, high quality ones, well-rated ones, to reach out for GDP, achieving GDP growth, which is very essentials. So Bajaj Finance can play a very, very vital role. I hope by this scale-based classification, they don't try to restrict the growth of high-quality NBFCs like Bajaj Finance.
I think they are now, in my view, a highly integral part of the whole economic system, because banks obviously can't be reaching out to everybody. So this NBFC was already, the concept is well established. I think the numbers look healthy. Probably they may be bigger than some small banks, and much bigger than that.
Yeah,
I think a very strong process. This is a very classic example, Santosh, of a very healthy company because of very robust processes, very tight operational controls, if you see. And the numbers, they are monitoring 0.67%, etc. I am sure they'll be working for a downward number of that. And, maybe, little, I think it's a classic example of that.
No, absolutely. Ramaprasad, see, in India, what I understand is, if you look at the history of NBFCs, or for that matter, even banks, the only reason for failure of any NBFC in India is, diversion of funds.
Yes. I was about
otherwise, the business model, if your collection is strong and if your cost of funding, etc., is reasonable, then typically, there is no dearth of borrowers in India. So if your processes, if your governance structure is right and your processes are right, and you have an example, a great example in, on screen. So this is what it is. I mean, there is no limit for growth in this kind of environment.
And with the huge rush in, a huge commitment by the government on capex push, I think anybody, I'm sure Bajaj is also doing huge commercial lending. I would only tend to think that the AUM quality will further improve. And, really, now that the niche segment funded by Sri is gone, so maybe that's another great market which could open. I think it's very well said. Very strong operational controls backed by diverse locations and a management team. I think the results are obvious.
Yeah.
And they cross-sell beautifully. They cross-sell other products, try and sell, cross-sell other products, and also they upsell to other customers. For example, once EMI is getting nearer, they know when the data which they have is, their data intelligence is awesome. So they try and lure customers with more exciting offers. So that's also working phenomenally. And they can create with the data, amount of data they have, they can create a mutual fund revolution, which is probably unthinkable.
They trade also at PE of, I think, around 50, right, Manoj? On an annual EPS of 116. I think kitna hai abhi stock ka bhav? I think kuch
6,000 order. 6,000 order.
So it's 50 plus, right?
So, price to book is greater than upward 6. PE kabhi dekha nahi. Nice.
So market has also rewarded them in that sense.
Fourth quarter EPS is 40.
And inka sabse bada, see, this is my reading. See, inka ek aur reading in between the lines. They are one of the few NBFCs based in Pune. Other NBFCs may not be there. So inka ek aur hidden advantage kya aata hai is, see, in Pune there are other financial services companies nahi hai. So they are able to keep their attrition also in check.
There are many financial services companies in Pune,
Yeah, of course, that vaccine wala is coming, but I guess
Magma hai na, Pune wala.
yeah, Magna, but relatively lesser, a niche,
Lesser.
relative, not as big as.
Not as big as Bombay or Chennai.
Yeah. So what happens? See, I worked in the insurance space for a long time. So Bajaj Life and General both have at senior level, senior manager wo level pe, they have people with 8, 12 years, 8, 10, 12 years is very common. Because कोई आदमी पूना छोड़ के दूसरा जगह आएगा नहीं. पूना वाला बॉम्बे नहीं आएगा.
True.
ऐसा है, because उसको even afford नहीं हो पाएगा.
Correct.
So they are automatically able to, that is hidden advantage, और कोई नहीं है.
Correct.
ऐसा है. Of the scale of.
उसका promoter ही नहीं आता पुणे से बॉम्बे तो.
Correct. ऐसा है. So that is one hidden advantage बोल सकते हो. They are able to keep their costing also relatively low.
Manoj ji?
It's a national level firm and growth is across all territories and going deeper and deeper penetration. So it is an insight, the foresight of the promoter, and as we mentioned, the systems and processes, which has created a very, very successful, high growth and well-managed NBFC.
Right.
The best in the country.
Yeah.
There are many followers. I hope they try to achieve even some of the excellence. That will go a long way.
Yeah.
So I had just only one, maybe 30 seconds to add, Santosh. Since the whole idea of having a digital push, right? So that I'm sure the company would also be taking cognizance of increasing their digital infrastructure, right, to cope up the new strategy that they are planning to place, right? If you would see the recent happenings of cyber attacks and all, they're increasingly common. So for example, what I came to know yesterday is that SpiceJet has delayed the results because of ransomware, right? So something which we could only visualize or experience in a sci-fi movie is now happening in real life, right? So maybe that could be one area what we should focus when we also look at assessing the controls or the overall health of the particular entity.
No, absolutely.
Of competition in the digital space, many digital focused companies like Navi are there in the market raising funds. I believe they are raising NCDs at over 9%.
Yes.
So cost of funds makes a big difference. As we said, 3% saving, 2.5% saving over the competition can make a big difference. Paytm is doing very well in funding now. It has a structure and systems in place, but let's see how it evolves in terms of size and scale. That's more important.
No, absolutely. I think these new generation digital lenders who were originally payment channels. I think Paytm is one. Navi you mentioned. Even this Capri, which is it's backed by an international BFSI. That is also quite promising. And then Cred is of course there. So I think these four are something which I would watch out for. So Manoj ji, I'll need to take some break. So if Nilanjan, aap agar le sakte ho, then
sure.
Once you're done, I'll then take up.
Sure.
Thank you.
Thank you, Santosh.
I'll of course be there.
Yeah. So I'll take off from where I think Ram and Hemant left. I think they left a very important point on intra-group lending and the the broader question was, how do we track or how do you come to know of certain instances? Well, so in these slides, we are going to talk about certain indicators which will kind of help us in assessing the overall financial health of the entity, and also it would give us a broad check whether there are some malicious transactions, or on the or whether these transactions are actually affecting the health of the entire entity. So moving on to that slides. Okay, so a bit about myself. I am a chartered accountant with 15 years of experience. My profile has primarily been in financial reporting, uh, corporate laws, and dealing with various emerging issues. Caro and all those things are the recent one, which is taking a bit of my time. Now, as a disclaimer, these discussions and all these slides are only the independent views of the presenter and are only for knowledge sharing purpose. Uh, they are important deliberations on the part of India growth story, discussion purposes and awarenesses, and they do not necessarily form the view of the platform or the institute. These are purely and purely for education purpose. Please consult your own advisor before you take any decisions on the subject matter. Okay, so moving on, I think we had looked at all this a couple of times. The unwinding effect of COVID, the new requirements, the focus on financial and non-financial information. So that's how the year had been. Okay, in this response, the MCA had explained and they have brought out multiple new reporting requirements to strengthen the overall financial reporting framework. So if I bifurcate them from a theme perspective, we did in our previous calls covered the financial irregularities, questionable transactions, and intra-group lending. Today we will cover, as I mentioned, about a health check on the corporates. What are those triggers that as an investor or that as any stakeholder, including the credit rating agencies or society at large, be looking at to assess and to make an objective decision about the particular entity. Okay. Okay. So how is it important? It is important for various stakeholders to aid objective decision making. More and more granular information would be made available in the financial statements. But on the flip side, there is obviously an increased effort by the auditors as well as preparers of financial statement. And as I had been insisting earlier as well, an early engagement on all these matters is very key for effective implementation of the new requirements. Okay, so I think this we used to always read in our, if I can use the word, childhood days, be it aging of trade receivables and trade payables. Fortunately or unfortunately, the Ministry of Corporate Affairs has now made a specific requirement to disclose aging analysis of trade receivables and trade payables in the financial statements. And there is a particular format, if you would see on the slide, has been prescribed. Now, one can always ask or ponder why for such basic things are being put up in the financial statement as a mandatory disclosure. Well, I think there had been concerns where the aging analysis has been has not been given appropriate attention by the preparers as well as by the auditors. So that had led to a specific disclosure. We are more or less familiar with the aging of trade receivables, but there is also a requirement now to disclose the aging of trade payables. If you would look at the disclosure requirement, these are supposed to be disclosed in 3 or 4 buckets, which are less than 6 months, 6 months to 1 year, 1 to 2, 2 to 3, and more than 3 years. And again, there's a total column. Having said that, these particular information are also required to be subdivided into various categories. And if you would look closely, there are 2 broad categories, which is undisputed dues and disputed dues. And again, there are further bifurcations to this broad category. In my personal view, this particular information of trade receivable would be of vital importance to credit rating agencies, to various readers of financial statements who would be very keen to know whether what is the state of the recoverable, to what extent the entity feels the amount will go bad, right? So this would be a good point of reference for all the stakeholders to assess the financial health. Similarly, from a trade payable perspective, if you would see, there is a disclosure to disclose how much is the amount of outstanding dues between 1 year, 1 to 2, 2 to 3, 3 years, and more than 3 years. Right? Again, the amount has to be disputed, has to be bifurcated between dues to micro and small enterprises, others, and disputed dues. Okay, and we'll also talk about what is meant by a dispute in subsequent slide. But in a nutshell, the message which I want to pass on is that the aging disclosure is an integral part of the financial statements now, and it might require some amount of deliberation since this is the first year of implementation. Okay, so some of the key considerations which I thought I should leave with you. There is the total of the aging has to tie with the total amount sitting in the financial statements. So what the institute felt that in order to do that, there has to be 2 additional columns that should be inserted. For example, the amount of dues which are unbilled, that has to be inserted, and the column for dues which are not due should be inserted, because unless we do that, the amount will not tie with the balance sheet. Second important consideration, the aging has to be computed from the due date of invoice. Right now, what is due date? Normally, it is stated in the terms and condition of the purchase agreement or your sales contract. Normally, you would compute your dues from the date when you are supposed to from the date when you have sold the goods or have rendered services. If the due date is not agreed in writing or in oral, then the aging has to be computed from the transaction date. Normally, I would expect the transaction date to be the date when you are recognizing the transaction in the financial statements. An important consideration is what is meant by a dispute. Now, one could argue that I would say an item is disputed only when you have initiated a legal recourse. But that's not how the accounting works. Accounting is more into substance rather than legal form. So keeping that objective in mind, the ICAI has given a broad definition of dispute, which states that dispute means any disagreement between 2 parties and is demonstrated by positive evidence which supports or corroborates the fact of disagreement. Okay, legal proceedings is only one of the indicator for dispute. And they have also given a reference to the bankruptcy code for assessing or getting a direction on what is meant by a dispute. In my personal opinion, we could face situations where the dues are pending reconciliation with the vendor or a customer. That's where basis on the evidence that has been put forward by the management will ultimately determine whether there is a positive evidence to support a disagreement. Normally, there could be there could be a possibility that the evidence that is provided is skewed to achieve a particular outcome. My humble submission to you would be is that in those situations, please use heightened level of skepticism, considering that these numbers will ultimately be disclosed in the financial statement under various granular heads. So unless you have a very clear cut evidence to say that there is no evidence of a dispute, I would tend to believe that there is a incipient dispute happening when there is when the dues are not being paid or the dues are not being received for a longer duration of time. Okay. Now, what the ministry has also.
Nilanjanji,
Yeah, Hemant, please. Sorry.
See, at this point of, I would like to ask you one question.
Please.
As regard to a professional, it's important for me to, establish the name of the parties or.
I can't hear you, Hemant, very clearly. Sorry, there is
company.
Your voice is breaking. I can't hear you very clearly. Sorry.
The audited balance sheet which are and can you hear me now?
I can hear you. Yeah.
Is it clear now?
Yeah, it is better.
Yeah. So yeah, in insolvency, it is very important for us to avoid the law of limitation and everything. That my name is already appearing in the balance sheet of the corporate data. So sometimes we find it very difficult to get name to establish that our name is in the balance sheet of the corporate data, because corporate data's balance sheet doesn't reflect the detailed balance sheet. It doesn't reflect the everything. It only reflect in public domain. It reflects only the in balance sheet part of or not part of it. So how to the daily balance sheet in that case, whether sometimes company not cooperative, she's filing a suit against the company. So can you suggest some way?
So Hemant, if I heard you correctly, what you meant is that if a customer of mine is under IBC, right? The entity who is supposed to receive money may not share the relevant detail with us, right? Is that the case that you're trying to ask? Yeah. Okay. So I think
Right.
Yeah, I think Hemant,
how to establish my name is AP.
Yeah. So I will tell you. So I don't think here the guidance is requiring the auditor to go and verify whether the name is appearing or not. I think what they're only trying to say is that when you're looking at dispute, what are those criteria that you should look at whether the due is disputed or not. Okay. So instead of saying that the ICI will develop another set of definition of a dispute, they have said that you use the definition of IBC, right? But having said that, if there is a case where where you are supposed to recover money and the customer has initiated recovery proceedings, I think the first point of contact would continue to be the management, right? If the management is providing that information to you clearly, then you have have limited concern. But if there is a concern that the management is not able to inform or provide sufficient information, my submission to you would be that you use other alternatives audit evidence sources. For example, when you sent out confirmations, right, you might even ask a question, right, whether you are under recovery proceedings or not. So nobody stops you from asking that question. So ultimately you have to build out ways and means if you believe the information sharing is not is not proper, because ultimately what will happen is that it will increase your work, on the sample size or on the number
This
of
problem we face
procedures.
is limitation.
Sorry.
This problem is faced by us when there is a law limitation which is applicable to, and that his name is appearing in the balance sheet date also. Because transaction at 3-4 years old, more than a year old, it is very important for him that he's already displayed in the list of creditors. So to avoid law 3 years, we have to establish it is not applying because there is a Supreme Court judgment that in balance sheet the law of limitation will not use.
No, so I think that is more from a legal angle, Hemant. The idea is not to go into that legal angle.
Clear?
Sorry, if I can continue. The idea is not to go into the legal thing from an accounting perception, but when you are looking at dispute, right? One of the way to look at is that there is a legal proceeding or not, right? So if there is a legal proceeding, right, so then you would need to make appropriate disclosure. To answer your question, Hemant, if you would go back to the disclosure requirement also, right, there is a situation where they have said that the dues are disputed, but they're still considered good. Okay, so that doesn't mean that each and every dispute cases will consider to be a bad debt, right? Ultimately, it would depend on the evidence that is being made available to you. If again, if I can reiterate that that there is a concern about information sharing, we as an auditor has all rights to have an alternate source of audit evidence. Confirmation, as I told you, is one of the most common source. I don't know whether this answers your question, Hemant, or not. Okay, I'll take that as a yes. Okay, so moving on to the next slide. Another way, or one of the most thank you, Hemant. One of the most common way to look at the financial health of the entity is to look at ratios. I think this is the most common or the most widely used matrix which people use to assess financial health. Now, this has also formed a place in the financial statements. Okay, so if you look at the slide, there are 11 ratios that has been prescribed for all companies in India, right? So there is no exception for a private company, public company, Section 8 company, or any other company. Any company which is required to prepare financial statements under the Companies Act, this disclosure has to be given, and there are 11 ratios. What it also states is that if there is a 25% difference in the ratio of the current year as compared to the preceding year, then there has to be a proper explanation by the management, right? So people who are familiar with SEBI requirements can very clearly see that most of these ratios are very common to those which have been prescribed by SEBI for entities which are debt listed, right? So SEBI regulation, SEBI listing regulation also prescribes certain set of ratios, and these ratios, what I found was largely common. Sorry, as far as the numerators is concerned, the numerator has to be drawn up from the respective items in the financial statements or from the notes to the accounts, right? Now, ultimately, the question is that what is the formula should I use? The ministry doesn't give you a specific formula. ICI provides certain guidance. In their guidance note, they have given a list of formulas that can be used for various ratios. However, they have categorically said that these are only for illustrative purpose, and there could be other sources from which these ratios could be derived. For example, the investor reports or the industry reports. So in a nutshell, it is not that we need to have one fix kind of a formula, but because various entities would have different a perspective. For example, a new age entity or a startup entity might look at a particular item, for example, return on equity in a different way as compared to a more mature or a or a entity which is in the manufacturing space. So the disclosure itself provides flexibility to use an entity specific formula, but obviously there has to be an overall framework based on which the formula has to be derived. What is very clear is that these ratios should be consistent with other places in the annual report. So normally what I have seen in the annual report, various ratios are mentioned. For example, return on equity, return on capital employed, return on investment. It is important that we use the same basis, because ultimately if I am a recipient of the annual report, I would tend to get confused, right? That what is the current ratio which is demonstrated as X number in my annual report, whereas in the financial statement it's Y. Ultimately, there has to be a cohesive way in which the ratios are being derived. Most importantly, if there is a 25% difference, there is a requirement to explain. My suggestion to you would be is that when you encounter those kind of a situation, try to have those observations or reason for differences in a more insightful manner. It can't be right that my debtors have gone up only because there is an increase of sales, right? Or my payables have gone up only because I have entered into more amount of purchases. What as a reader would actually need or actually want to experience is that why your purchases have gone up, why the sales have gone up, right? So I would strongly suggest that you look at these disclosures more as an opportunity for the company to tell their story, right? It is not that it should be looked at as a tick in the box approach. It is the way the entity can have very beautiful ways of telling their own story, right?
And one point from an audit perspective,
Yeah, Ram,
Nilanjan,
please.
to add to your good presentation, one thing would be we should probably definitely audit that 25% more than swing and understand with our own audit work which is done.
Exactly.
So that if there are any gaps in your work or you are not able to conclude or agree, you probably need to go back to your audit planning memoranda or your procedures and see whether you missed something. It's actually between you and me. I was actually reviewing one accounts the other day. It actually became very handy for me to actually correlate a lot of stuff our colleagues have done. And so that's actually, this must be used more from an audit angle to ensure that our results are consistent. Also gives a double comfort to us that, okay, we are not way off the mark. Correct. I thought I should just add so that people.
No, very nice, Ramaprasad. In fact, if I can tell you on a lighter note, this also does reduces the work of the auditor to certain extent, because at the year end we normally do the variance analysis, right? So this is kind of a place where the entity itself is doing its own variance analysis, and this will only be helpful for the auditor when they are documenting or reaching out to a particular conclusion.
And I think management must also be really educated that this 25% swing is actually a big catch for them. If it's like a debtors turnover ratio, there's a swing, and the number of days goes up. Obviously, there's a lot of questions the bankers and all are going to ask. So I think a lot of education must be given to these boards, because I find I mean, this year it's going to be very tough for them. Maybe it will take 2 years for this whole thing to stabilize and mature. But yesterday, one MD was telling me that some messages which we give down the line, people actually take it. You control the cost. He was telling it there was a discussion on controlling cost, and people took it as controlling cost at the cost of non-compliance. He was telling me, it became so embarrassing for us.
Yeah,
A small matter.
correct.
He said, people are stretching it. So probably, to the management on our side, without digressing, the management must be explained that this 25% swing could harm them.
Yeah.
On the positive side, it will benefit them because of better rates, etc. On the other side, it could harm them from a ratings perspective, etc., etc. And actually puts more responsibility today than on the rating agencies and auditors. So
Exactly.
That swing is there.
Yeah, that's exactly what I started saying, that I don't think these are onerous, or in that sense they are so burdensome for the entity. Ultimately they can help and tell their own story. Right? And ultimately from a user perspective, there is a plethora of information that is being made available now. Right? Which at least I would not have seen in so many years of practice. Right?
Absolutely.
So humongous amount of data. Now it is all for us to mine those data and reach to an objective decision.
Please carry on, Nilanjan.
Yeah.
Good. Yeah.
Thank you, Ram. So moving on to the next slide, this is just a culmination of what we discussed in the prior two slide. Now, as far as the auditor's reporting is concerned, based on the auditor's analysis of financial ratios, aging, and the annual report, the auditor is required to comment if there is a material uncertainty in repayment of liabilities. So the words which I would like you to note is a material uncertainty in repayment of liabilities. Now, you can always correlate the term material uncertainty with going concern, but here the perspective which the ministry is trying to look at is more restrictive. They're trying to look at liabilities only. Okay, so what I would like to highlight is that the assessment in reporting in Caro as far as liabilities is concerned is quite different when you are assessing the going concern of an entity. And I have a slide where I have tried to put down my thoughts where there could be a difference in outcome in these two scenarios. Okay. So as I said, the emphasis is on the company's ability to meet its liabilities. It is different from the assessment of going concern. There is a definition in the accounting framework on what is meant by financial assets and financial liabilities. Right? The auditor is supposed to test the existence of material uncertainty as on the date of audit report for the position existing as of the balance sheet date. So let's say there is a liability of rupees 100 as of 31st March 22. I am supposed to verify whether by the date I sign off the audit report, which let's say is September 22, whether there is an uncertainty that this 100 rupees is capable of being paid or not. If there is a doubt, there is a requirement for me to comment here. Okay, so a very I will not say good, but it's a very, again, insightful information which is going to tell you about the financial health, especially the liquidity position of the particular entity. What is also need to be appreciated, that whether I have a ability to pay or not is not required to be assessed on a one-to-one basis. I'm not supposed to check whether there is a liability of rupees 100, whether there is an asset of rupees 20, all those things. I need to do a holistic assessment, right? So more like a cash flow or a fund flow analysis. I need to look at my sources of fund. I need to look at the liabilities which are due as of a particular date, and a difference whether do I have a shortfall or do I have a surplus. Okay. What I would like to also caution you, the word used is payment of liabilities. That doesn't mean that I will only look at current liabilities, right? From an accounting framework perspective, I could have a long-term loan, a portion of which is due within 12 months, that is shown as current liability. When you're doing the assessment, you disregard the current liability or a non-current classification, you look at the original tenure of the loan and then do that assessment. Okay. Test of material uncertainty has to be done on the date of the audit report. The auditor should also consider the transactions subsequent to the balance sheet date, but till the date of the audit report to conclude on this particular transaction, on this particular comment. What is very common phenomena in India is that support letters are being provided by the promoter or by the holding company. So in that case, when if you encounter those situation, there is a requirement that you also assess the financial credentials of the support letter provider. Right? It is not that there is only a piece of paper which is being handed over to you. There should be very clear-cut evidence in your file that the provider or support letter has the ability as well as the willingness to support in case the liability devolves on them. Right? This is also a very common evaluation that we do from a going concern perspective. But since this has been specifically brought out in the requirement in the Caro.
Nilanjan?
Yeah, Manoj.
Yeah. This is a very innovative and new requirement which gives a much larger responsibility on the auditor.
Yeah.
Because he has to comment on the solvency and effectively pay payments to be done for liabilities to all the operational creditors, financial creditors.
Yeah.
Now, we talk about best practices and global practices. Which countries have this requirement so far, or India is leading in this?
So I would say, Manoj, in my experience, I don't recall any jurisdiction where there is a requirement to report on liabilities, right? What I can see globally is that when you talk about financial health is looked at more from a going concern of the entity, right? That as an auditor, we are anyway supposed to check. Right. So now what the ministry has done, they have created a subcategory, if I can use that word, where they have talked about only on repayment of liabilities. Right. And I would come to subsequent slides to show that how the assessment could be different or the outcome could be different. But to answer your question, I don't recall of any jurisdictions unless unless Santosh or Ram had some insight. I could not find any jurisdictions where there is a specific requirement to comment on the solvency of a company at a particular date.
I don't think so. Is there any? There is no other jurisdiction, in my view. Yeah.
So even
and I also add, I like this point that you made, Nilanjan, auditor to consider subsequent period transaction data, balance sheet, and data of audit. That's I think the most difficult one.
Yeah.
And one must read that very carefully with this 11E also. Possible that somebody may very cleverly put a transaction on April 15th. Which could definitely impact your liability.
Yeah. And Manoj, also to correlate, this is not a new thing which we do from an India perspective. If you would look at the regulation on buyback, right, we are also supposed to comment on the solvency of an entity on a particular date. Though I could still appreciate that buyback will not be common across entities, but from a regulatory framework perspective, we are used to assessing the solvency of a particular company. Now the only difference is that all the companies in India had supposed to pass through that test. Earlier, it was only for entities which were going through a buyback process.
Buyback, yes.
Buyback is different because equity, which is a main risk provider of business, the funds are going out to them. So that is also in case of certain limited companies. Now here you mention it is applicable for all corporates in India. Right?
All companies in India.
Two things come out especially is as of now, this trend of comfort letters was preference of bankers or lenders. Large lenders, they required a comfort letter from the promoter or some of the associate companies, stronger ones. We also have seen in the case of Tata Tele, balance sheet is very bad. there have been huge losses, but the balance sheet has not been restructured by way of fund infusion from the promoter or by way of a rights issue or a preferential allotment. But we talked about a comfort thing in the notes to accounts when we discussed the company's financial in deep dive.
Right.
Now, do we see the do you see the trend happening? Can the auditor ask for a comfort letter from the management and the promoters? And there are many cases, promoter or they may say, please don't qualify. We are there in case any creditor doesn't get money, although the ratios may not be very favorable. So auditor can say ratios are not favorable, particularly on terms of solvency or in terms of aging, long-term, short-term mismatch. So give me some comfort letter. Otherwise, there is no other option except for me to disclose with all the stakeholders. So do we see the trend happening and going up in a big way?
So Manoj, I don't think this reporting requirement or a disclosure requirement will change the corporate structure, right? Because these are only disclosures. They can't insist on a particular way business is functioning.
No, we are talking about the comfort letters.
I know. So I'm coming to that. So let's say a company X is having a bad financial credentials, and let's say its promoters is willing to support, right? I will not qualify this particular clause. I will say that I am relying on the support letter. Okay. I would mention that specifically. But most importantly is I am not the first one to make that statement. There is also a corresponding disclosure which is coming in the financial statement, right? So management will first obtain the support letter from the promoters or from its holding company. They would make appropriate disclosures, and based on that disclosure, I would comment on solvency. I will not be the first one to comment on aging or on ratios or on comfort letter for that matter. Right?
See, here the thing comes out that there is no comment in the accounts and there is no need for a comment in the notes to accounts.
Yeah.
But it is very apparent the current liabilities are more than the liquidity available. And in the next 3 months, 6 months, 9 months, 12 months, here we are talking about up to a year, that there are going to be difficulties in the payment. There is material uncertainty in repayment of liabilities.
Yeah.
So auditor has a clear responsibility of reporting.
Yeah.
So what does the auditor practically do? Will he go and report, or of course he will have to discuss with the management and take the management views?
Yeah. So first, obviously, a discussion.
And then the question of comfort letter comes. He will say, "What do I do now? There is material uncertainty. I have report."
Yeah.
So possibly the auditor will request the promoter or the management to disclose by way of a note.
Yes.
And also assure the users of financial statement in some way or another. And then what type of opinion happens?
Yeah. So in that case, my experience, first of all, Manoj, is that if there is a support letter, right? 99% of the cases, I have always seen a disclosure in the financial statement. I have never seen a case where there is a support letter and there is no mention of that fact in the financial statements. Ram, you can correct
Absolutely.
me if I'm
absolutely.
not.
I fully agree. There will be a detailed note.
Yeah. There has to be a detailed note from the management side. Stretching again from a management responsibility perspective, Manoj, forget the financial statements reporting requirements. Under the Companies Act, when the board prepare its report, they are specifically supposed to comment on the going concern. Right. So it is not that we are experiencing this for the first time. Probably this is only coming to us as a limelight. But from an assessment of from a management perspective, there is absolutely no change. Earlier also they were supposed to assert probably in the board report on the going concern of the entity. Now it is coming as a specific reference in the financial statement. That I think is more of a correlation, right? But from a management responsibility perspective, earlier I was to comment on going concern, I will still comment today. Now, as far as the auditor's responsibility is concerned, that's where the judgment lies, right? Let's say I am having a support letter. Let's say a company X, which is, let's say, a 1% of 1,000 or a 10,000 crore company. I know the might or the financial might of that particular parent, right? I will not say that the entity will shut down, right? I know, because whatever happens, that 1,000 crore company is there with me. What creates challenge is that if there is a doubt on the ability and willingness of the provider of the support letter, right? A couple of instances I have seen where the support letter is conditional, right? It says that if if some creditor is defaulted, let's say you are defaulting on bank loan, I will support only to the extent of bank loan, right? Or if there is a default by X customer, I would then come into the picture. When we talk about support letter, we talk about unconditional support letter. If the support letter is unconditional, then auditor is obviously having a very strong mitigating factor, which will affect my reporting. But yes, if there are uncertainties on the ability and willingness, and there is a condition attached to the support letter, I would say there would be a reporting on material uncertainty with going concern in the audit report, because that's a very big mitigating factor which is not available to me today, or I would say there is a doubt. Okay, but obviously there would be other factors also. For example, if the subsidiary in our example is looking for new investors, right? How close are those discussions, right? Is there a term sheet that has been signed off, right? Are there various unused lines of credits which I can use, right? Are there some unencumbered assets which I can still pledge and get those monies? So ultimately, the going concern assessment, Manoj, will not stick to only one mitigating factor. I would look at other mitigating factors as well. But yes, to answer your question, if there is an entity which is relying heavily on support letter, it would, in my experience, will give a note in the financial statements, and I would say that will be a consequential implication in my auditor's report as well. Right? I
No,
can't have a situation.
Another very important point. Most of the companies, in terms of groups, there are groups, business group for a professional, whether it's a small group of maybe 20-30 files for income tax and finance business, or it could be 1,000 companies for a large listed companies in the top 100. And these groups, companies are formed for certain business reasons, diversification or future use. And we have seen many companies. We can discuss at length later, but just to give one example, today Reliance Industries has got over 1,000 companies. We talked about Videocon also earlier. They would be having a couple of 100 companies. Now, what happens here, whether you take Larsen & Toubro or whether you take Tata Steel, there are 200 plus companies. Whichever Reliance group you take, whether Industries or another one, which has Reliance Infra, Capital, etc. Now, when you see their companies, associate companies, subsidiary companies, over 70-80% of them have very low equity capital. Just 1 lakh rupees, 2 lakh rupees, even 5 lakh rupees is rare. And many of them have liabilities, which we are talking about. Most of them are current liabilities. They are not long-term loans. They may be 20 crores, they may be 100 crores, they are even in some cases 2,000 crores. With just a few thousand rupees as equity capital. Now it is very clear. Now those companies are accessible today thanks to the company law requirement. They are supposed to be posted on a website. Now a person who has a responsibility stakeholder would like to look at such companies. Now it is very, very clear, prima facie, when you have a capital of 1 lakh crores, Sorry, capital of just let us say 10,000 rupees, 50,000 rupees, 1 lakh rupees, 2 lakh rupees, and a liability of 100 crores. So based on our financials, at that time, this was not required for them. Many of these companies don't even prepare an annual report on the business. They are the subsidiary companies, associate companies. Now it is very clear there is material uncertainty in terms of repayment of liability. Unless a proper structure of equity and debt is done of a proper acceptable debt equity ratios and current ratio. Now there are thousands of companies in respect of each business group. So this isn't this is a game changer, because auditor, the group auditor would look at the subsidiary companies, associate companies also. Each of them have different auditors because of the limitations on the number of audits auditor can do. Now it applies to each and every company. That means there is a duty on the auditor to look at the subsidiary company, associate company, particularly which have got low equity.
No, I think Manoj,
yes,
please.
What does that happen?
So I think the way that happens is a bit different, because in India, under the Companies Act, all companies are supposed to be audited, right? So let's say the example you gave, that company X will have 100 subsidiaries in India. All those 100 subsidiaries will be audited individually by their individual auditor. The parent auditor can be same in certain entities, they may not be the same. But ultimately, when you are reporting on the entire group, I don't go and re-audit those 100 entities. Okay, I rely on the audit report of those 100 auditors, right? And I state that I have placed reliance on the audit report of those auditors, and I am commenting. Now let's take a scenario where out of those 100 subsidiaries or 100 auditors, 2 of them had given a negative remark. Okay, so now as a parent auditor, I would have to apply judgment that how material those subsidiaries are at a consolidated level. If they are material, those observations or comments will automatically flow back to my audit report.
So for example, today Jio has over 100 companies. Reliance Jio in terms of associates, and because that's the way business is done in India. You need to have a distribution setup, and so many states are involved, so many different verticals are involved. So, but in those associate companies, in case you have an equity of 1 lakh rupees and liabilities of 100 crores or above, or even more than 2 times, so the respective auditor would have to request for restructuring of the financials, right? The days of 1 lakh equity are over.
No, I don't think so.
There is material, because there is very clear material uncertainty in terms of repayment or liabilities with the equity capital of 1 lakh rupees, and maybe liabilities which are funded by group companies only of multiple lakhs, over let us say 5 lakhs, 10 lakhs, 50 lakhs, 1 crore, 5 crores. What does auditor do in such cases?
So in such cases, Manoj, even though the equity capital is low, right, there's a higher probability that those entities will have long-term loans. Okay.
No, the terms of loans are not stipulated.
No, it could be, but
so they are current liabilities or unsecured loans, but terms of repayment or not. So that means legally they are payable on demand.
On demand, correct. So in those cases, Manoj, what I have seen is that they would rely, on support letter as the primary source of mitigation, right? So I don't think that the corporate structures would change only because of there is a separate disclosure requirement. But yes, what I can only foresee is that there would be a more emphasis and more focus on this particular information, right? Whether the entity is able to settle its liabilities within a period of 1 year or not.
So that means the auditor should ask for a support letter, and if in terms of liabilities there are, let us say, 5 companies involved in funding the liability part of it, so that may be a request for 5 letters.
And if those letters are not available, then in our example where there is a low equity and huge amount of dues payable, then you can surely expect a comment by the auditor in this particular clause of Caro.
So this is a trend, and we should also expect to see comment in the notes to accounts by the management themselves.
Yes.
Before the auditor asks for it.
Exactly.
And they should themselves mention about the letter of comfort or guarantee or whatever assurance required. To see that there is no, because what will actually happen in some cases, these are mutual understandings. In some cases there are external liabilities. And external liabilities are at high risk, as we have seen from the ILFS, DHFL,
correct,
Videocon, and so many other bankruptcy company cases.
Right.
Yeah,
and
Manoj,
possibly,
I would like to.
Mr. Hemant, your views.
Yeah, I would like to add in that, whenever some company comes to insolvency and we go through the balance sheet, audited balance sheet of the company, which is immediately preceding year of the bankruptcy, there is no any red signal as such. Auditor is giving all the things in a regular manner, and all of a sudden, how can the company become in IBC? We get surprised. And sometimes we get it. No, there should be some provision under the, additional provision under the Caro and everything. So now it is, a good thing that this all changes has been incorporated, because I have seen in the case of I was handling one of the Z companies, group company. It is an infrastructure company, and gone through the balance sheet of earlier years. And there is no any red signal as such that that the company might go into insolvency in the future date if this and the capital is very thin, 1 lakh rupees, but the borrowings are 400 crore and more. So it's really a good thing that this all these additional checkpoints are been incorporated, and that has been made mandatory for an management as well as the auditor to report.
Right.
This is a very, very important good point you raised about this business group in infra also, which was a defaulter, and the promoter ultimately paid off over 90% of the loans. But now here, this means auditor is expected to play an important role in prediction of bankruptcies, and would be very useful for all operational and financial creditors.
So I would not say, Manoj, that the auditor is supposed to crystal gaze. They are not supposed to predict the future. In fact, the guidance from ICI, if you would look at the manner of reporting, they have said that only because they are able to pay the dues on time, that doesn't mean that we are commenting on the viability of the company. Okay, I think we need to read this in the intended way, where they're only trying to report on the financial health of a particular entity at a particular point in time. We should not extend this to say that whether the entity will be expected to continue this momentum or not in the future. That's only the time can say. It is only an assessment at a particular date, and in my view, we should limit it to that.
So form a view for the next year, right? That's the requirement.
Yeah. Yes.
So important, the changing role of auditors.
Yes. Okay. So another important point, and this is not a new requirement, but it was deleted in the previous Caro, but it has been reinstated, where the auditor is supposed to comment whether funds raised on a short-term basis have been used for long-term purpose. Again, this would highlight the financial health or solvency of the entity, because if we are using short-term funds, let's say a working capital loan, to fund a capital project, right, then there is obviously a crunch of liquidity in the particular entity, because the short-term funds will be due in the near future, whereas the payback from the capital projects would come after a certain period of time, let's say 5 years or 7 years. So again, here the requirement is to do an overall analysis of what is the short-term funds versus the long-term funds of long-term utilization of the of the entity. If there is a gap, then there is a matter of concern because there is a crunch on the financial solvency of the entity, right? Normally, in my experience, this is done on an overall assessment basis. However, where uh, a liability to its utilization is monitored, a one-to-one relationship can be made. For example, entities which are on the financial services sector, or where the entity publishes the asset liability management kind of asset liability maturity analysis, there a more one-to-one relationship is evident. But normally, this type of an analysis is done on an overall basis to see whether short-term funds have been used for long-term purpose. Yep. Okay. Next one is on cash losses. Again, the auditor is supposed to comment whether the entity has incurred cash losses in the financial year or in the immediately preceding financial year. If yes, they are supposed to state the amount of cash losses. Now, what is meant by cash loss is not defined neither in the Companies Act or in any accounting framework. But what I would like to pass on a message here is that when we talk about cash losses, that doesn't mean that the company is required to follow cash basis of accounting, right? We are still following accrual basis. We are not following cash basis of accounting. The requirement here is to start with the net profit or loss from the financial statements and add back non-cash items. For example, depreciation, be it your deferred taxes, all those things. It no way mean that you compute the profit or convert the profit for the year from an accrual basis of accounting to a cash basis. So please don't do that. The requirement is only to make certain or limited adjustments. There could be situations where there are qualifications that has been made by the auditor. Those qualifications, if they are those qualifications are also required to be adjusted when you are computing the cash losses. In case out of 2 years, the company has made cash loss only in 1 year, then the auditor is supposed to make appropriate remark to say that the cash loss has made only in 1 year. Okay. Other key matters which I thought would be important, and couple of them, for example, internal audit. There is a specific requirement to report whether there is a proper internal audit system which is commensurate with the size and the nature of the entity. Most importantly, whether the reports of internal auditors for the period under audit were considered by the statutory auditor. What the ministry felt is that the certain instances where the audit reports of internal auditors were not shared on time with the statutory auditor, or where they were not provided at all. Now, because of this specific reporting requirement, auditor is supposed to go back to the management and ask for all internal audit reports, be it draft or final, and consider them in making their comment in this particular clause, or when they are opining on the overall true and fair view of financial statements. If there is a situation where the internal audit reports are not made available, or they are still work in progress, the auditor would supposed to make appropriate remark in the audit report. Okay. I think reporting on CSR, we all are aware that the Companies Act has a specific provision relating to contribution to CSR. Recently, the Act was also amended to state that the unspent CSR amount are supposed to be deposited with the government with a particular period of time. Now, under Caro, the auditor is supposed to comment whether the transfer of the unspent money within the prescribed timelines has happened or not. This slide just tells you what are those timelines. So if the company don't have any CSR project, let's say they are not building any schools, or they are just contributing to a particular trust, there is a timeline of 3 months within which the unspent money is supposed to be transferred back to the government. If it is on a long-term project, for example, school, roads, all those things. You have a particular time period within which is 3 years, within which the unspent amount has to be spent. If the money is not being spent within 3 years, then again within 30 days they are supposed to be transferred to the fund maintained by the government. Okay, one last thing, and then I can hand it back to Santosh, is that Caro is normally reported on the standalone financial statements. Now, what has been stated in the 2020 version of Caro report is that if the component auditor, be it subsidiary, associate, JVs, is having an adverse or a negative remark, then as an auditor of the holding company, I am supposed to state in the audit report on consolidated financial statements which are those clauses, which are those entities where there had been a negative reporting. So in a nutshell, the parent auditor is not supposed to replicate the observation of the component auditor, but they're only supposed to indicate which are those entities and which are those clauses where the component auditors had a negative remark. Okay. Another very important thing, the principal auditor is prohibited from using any judgment of materiality. Since the requirement is just to refer to the clause number, the principal auditor is not supposed to restate or reassess the materiality consideration at a group level. What has been presumed is that if it is an observation for the individual component, it will continue to remain material for the group as well, right? So no considerations for materiality at group level. Well, that's all I had to cover. In case there are any further questions or clarifications, happy to do that.
Superb insights.
Yeah.
Well done.
Yeah. Ram, Santosh, if in case you have
only point on the material uncertainty, Nilanjan, to add to your presentation and perspectives.
Yeah.
I think the one thing that we all have to be very careful is to ensure that audit team looks at the order book position of the company as well.
Yeah. Yeah.
Whilst because of the particularly in industries like automotive and all, where the demand supply is on a sine wave type of a situation.
Yeah.
It's a very healthy from audit perspective to look at the order book position, etc. Earlier we used to do it for going concern and all, but this time now since we are making this report specifically in Caro, I think better to get it as an audit procedure itself and look at it so that people know that we are covered from all perspectives and we don't miss out something as fundamental as that from a documentation perspective. That's all I wanted to add. But otherwise, excellent insights and very, very useful thing, Nilanjan. Yeah.
Thank you, Ram. Thank you. Well, that's it. I think Santosh is here. I'm not sure whether.
Yeah, I'm here.
Okay, Santosh.
Wonderful, Nilanjan. Very insightful.
Thank you.
Thank you for the presentation.
I give it back to you, Santosh. Thank you.
देखता हूँ मैं मंडे को देख मंडे को देख 4 दिन हो गए ठीक है बताएं तो अच्छा
Bajaj are here now with NBFC sector. Talk about Muthoot. Again, in terms of distribution of Muthoot is a large NBFC group based out of South India. Primarily, their focus is gold loans. They are one of the, along with Manappuram, they are like amongst the NBFC lag financing, loan against gold. Between both of them, they would probably have a market share of 70-75%. They also have housing finance, home finance, microfinance, etc. But primarily, it's gold loans. Snapshot of performance, number of branches they have started with. FY 2022, it is 5,581 as against 5,450 last year. So again, year on year, there is an increase. Gross loan assets across the group, that is, this is figures I think is in millions. So they have what 64,493 crores. So year on year there is a significant growth of about 11%. So again, it's in sync with the industry growth, but it's slightly higher than the industry growth also. Consolidated level, the profits have also increased 4,000 crores as against 3,818 crores last year. Muthoot Finance contributes to 90% of the loan portfolio AUM and 98% of the profit. On a standalone basis, Muthoot Finance has loan portfolio of 58,000 odd crores as against 52,000 crores last year. So there is a 10% increase in year on year in terms of percentage. Of course, the other subsidiaries are there: Muthoot Home Finance, Microfinance, Muthoot Money, etc. And they have also acquired this Asia Asset Finance. Yes. In terms of profitability, 3,954 crores on a standalone basis, vis-a-vis 3,700 crores last year. We know that gold loans, as such, it's more lucrative. The NIM is generally higher than other loans. Of course, the risk and the administrative cost is also higher, but the net interest spread is also quite significant. Balance sheet, again, they have cash and cash equivalent of about this is what 10,000 crores. They have loans of 64,000 crores, 64,500 odd crores, and they have other assets and liabilities. Let's look at the borrowing side of the story. They have borrowings. They have debt securities of 13,175 crores, borrowings of about 40,865 crores. So P&L, they have total income for the total financial year is 12,237 crores. Profits of about PAT of 403 crores as against 481 crores. So the ratio of administrative cost to net interest income will be slightly higher as compared to what we saw in Bajaj Finance. India's largest gold financing company by loan portfolio. And again, they have very strong presence in South, but even otherwise in places like Mumbai, Delhi, etc. also they have significant presence. Core, of course, but core services, gold loans. They are also into money transfer business loans, DLPLs, etc. I won't get into this by Muthoot, this MFIN as such much. 73% is promoter and promoter group. Retail shareholding is 22%, and then there are FIIs and mutual funds of 3.75%. This is by and large known. I wouldn't spend much time on this. Here again, in terms of geographical spread, they have very significant spread in presence in South and East and also West. They, apart from competing with Manappuram, they by and large compete with the banks. So, again, as in case of Bajaj, they have significant presence. They have they published their digital initiative also since last few quarters, and I think somewhere I read that they process almost 60% of the gold loan on an online basis. rather than a physical basis. So they have significant focus on online lending. Gold loans, of course, we know that, the valuation, the purity of gold, etc. That is a significant exercise which generally increases the administrative cost. But at the same time, if things are fine, gold loans delinquency is much lower. In fact, the loss given default on gold loans can be as low as 10 to 15%, as against, let's say, a LAP of, say, in case of LAP, it can be anything between 35 to 45%. So gold loans, if the diligence is done properly, the KYC and the gold quality is evaluated properly at the initial stage, then it's the chances of chances of delinquency is much lower. Online gold loan, I said that they have very strong focus on digital initiatives. So they said that 33% of gold loan customers are transacting online, including through Paytm, PhonePe, and Google Pay. So this is something that they have been trying to increase. Overall, I wouldn't be much concerned about this company's performance. It's a strong performer. Asset under management has kept increasing over the years. They have given a graph towards that. Nothing more to add on Muthoot from my side. Manoj, Ramaprasad, or Nilanjan, anything, or anyone else, if anybody has anything to add?
I think this is a sunrise business, and people are encashing gold, using this and increasing the. I know many cases where people have also, they just take a loan, put it in mutual funds, get a better return. They're doing actually hedging of their own assets and building an asset base because of that. And seems to be a very strong company with the Kerala seems to have a big trend. Manappuram, Muthoot, Mini Muthoot. You've got this Yogakshemam. A lot of companies from that space, which are pretty strong. Seems reasonably with a good customer base. Yeah. No match to the size that we saw earlier, but nevertheless healthy. Yeah. And one point, I think, this 4,000 and odd 5,000 branches give a leverage for you to actually do many other products. I see insurance, but probably health insurance is the least penetrated still in the country. Those things are possible. I think the big ones, big tickets where they can make passive income using the infrastructure they already created. I think these could be an addition. I'm sure the management must be thinking in those directions already. But good points actually from the presentation. Yeah.
Muthoot, they have announced they are coming with a major digital initiative, a type of a super app. So possibly they have got good ambitions in that area. Another thing is on the competitive side, there's tough competition. IIFL, NBFCs is making huge inroads in that area, increasing market share. And another thing is also, particularly in the South, some banks like Federal Bank and City Union Bank, they are very strong in this domain business of where Muthoot had traditional advantages. Yeah. So it's to be watched, and technology, digital initiative can make a difference. It has to work well. Right. The processes, etc., collections, efficiency, and without compromising on the quality of the loans.
They compete significantly with banks, as Manoj, you rightly said, because out of the total loan against gold that RBI published, I think about 65, if I recollect properly, 65 to 70% is dominated by banks. So whatever's left, that is again dominated by Muthoot and Manappuram. But you're right, they compete significantly with banks, primarily because banks have the infrastructure, the branch, the last mile reach and all that, and valuation and all that. Experts are on board in case of bank. On the process and controls also, I think this loan, in fact, if you look at Muthoot's financial statements, March 21, you would find, and that is very common again for gold loan companies, you will find instances of fraud by customers on the company. So that
very,
is
very
again
normal
something
actually.
which is, yeah, which is a normal feature. So you're right, Manoj, when you say that, systems, the corruption in the system needs to be under control otherwise. Okay, moving on to another one, Mahindra and Mahindra Financial Services. I couldn't lay my hand on the investor presentation, but we'll have a look at the LODR results that they published. We'll focus on the annual figures, not the quarterly figures, just to kind of make it more comparable with the others that we took. Interest income of 9,475 crores. Bit of a decline there as against last year's 10,266. Total revenue again slight decline, 9,657 as against 10,456. Finance cost has also shrunk, 3,900 vis-a-vis 4,700 last year. Impairment or ECL provision, they have given a couple of notes which we'll see in some time. So 2,368 crores as against 3,700 crores. These are the standalone figures, of course, that we are seeing. Profit 988 crores as against 3,400 crores. Balance sheet size, again, if you look at the loan figures, there is an increase, 60,400 crores vis-a-vis 59,000 crores. There is a slight increase in the loan book. The liability side also, you have the deposits, you have the debt securities, borrowings and deposits. So 18,000, 26,000 and 8,400. You have net worth of 15,628 crores. Let's look at the notes. I'll focus on the exceptional notes. That was for last year, so let's ignore that. COVID guidelines which came last year, they had given some disclosures around that. Let's read item number 9. On 12th of November, the new IRAC norms came into picture requiring changes to and clarifying certain aspects of IRAC norms pertaining to advances. On 15th of February, RBI rolled back some of the proposals. The clause number 10 of that regulation got rolled back and it got deferred till September 22. So the company will implement the updated norms until 1st of October 2022. So basically this new IRAC norms which talks about daily NPA that has come into force from November. The clause which got deferred was basically relating to upgradation of the account. So if it's NPA, that is, DPD is more than 90 days, you classify it as NPA, and then if you have to upgrade it to normal account, it has to, the circular says that you need to recover all the amounts due from the borrower. And that is practically very difficult because ideally, if the borrower has defaulted on 3 monthly EMIs, then it's very difficult to get all the money of outstanding, including the interest and penal interest, and then to upgrade. So this company has not. So that got deferred till September. So this company has not implemented that. That was voluntary now. Note number 10, the company's net NPA, net stage 3 assets ratio stood at 3.36%, which is in line with regulatory expectations of RBI. So as compared to Bajaj, which was 0.68, this is net NPA of 3.36. In terms of requirements as per RBI, so this is the March 2020 circular of RBI, which requires Ind AS. It clarified that ECL, if it is lower than the RBI requirements, RBI IRAC norm provision, then you need to create an impairment reserve. So impairment allowances under Ind AS 109 made by the company exceeds the total provision, and accordingly, no amount is required to be transferred to impairment reserve. So that is, in their case, it's a normal scenario where ECL is higher than IRAC provisions. The normal disclosures as per the RBI requirements. Based on the RBI inspection, the company has been advised to refund excess interest. So interest on interest during COVID period, that was supposed to be refunded back. So accordingly, the company has made provision of 181 crores for the current year, inclusive of 142 crores for quarter ended 31st March 2022. And the company is in the process of refunding this amount. Wouldn't spend much time on the ratios, the normal disclosures. Let's look at these ratios. For year ended March 22, debt equity ratio is 3.57 as against 3.98 last year. Debt servicing coverage ratio is not applicable. Then you have the operating margin. I'm looking at Q, which is 10% as against 3% last year. Capital adequacy ratio is 27%, which is quite healthy. Then you have the gross NPA rate of 7.86 and net NPA of 3.36 this year. The provision coverage ratio is also 58%, which is also quite. At a consolidated level, the total revenue is 11,300 crores as against 12,000. Slight shrinkage in the revenue. Last year, there would have been some one-off revenue, which is why there would have been a decline. Otherwise, the loan portfolio has increased. Let's see the loan size. At an overall group level, it is 67,000 crores vis-a-vis 7,000 last year. So almost more or less the same size of loan book. Not much increase there. Yeah, I think nothing more to add from my side on this.
This is interesting. Although the report quarterly has got excellent disclosures, in terms of the substance. But when you compare with today, we had a very good deep dive insights into major of companies like Bajaj and Muthoot. Bajaj has shown very high growth quality of business model is good. Efficiency is there, but they have showed very high growth. And looking at the background of the promoters, both are from the auto expertise. Bajaj from the two-wheeler and three-wheeler space. Mahindra from the SUV space and going into commercial vehicle as passenger cars and two-wheelers also now. EV also. But the numbers, there is no increase in AUM at all.
Yeah.
Now, there was one other factor, based on the ECL report, the stress assets were comparatively higher. Bajaj Finance had NPA below 1%, and here the GNPAs were over 5%, which are coming down. The focus is rural, the focus is auto, but a big difference on how different companies are able to capitalize on the same environment. Both are into rural. Mahindra talks about, besides auto, a rural business, tractor, etc.
Yeah.
And which has shown good GDP growth. Agriculture has shown good GDP growth. Two-wheelers, there has been huge demand. Four-wheelers, auto sector also, there is a huge demand. There are only supply chain issues like chips and all that.
Yeah.
But a big difference. So here, disclosures apart, maybe the worst is over. Mahindra was the most conservative in providing for provisions for loan. In the earlier quarter itself, in fact, in the Q1 itself, they provided a huge provision. And then they said the worst is over. We'll keep on now recovering and writing back.
Right.
But Bajaj Finance is going ahead by leaps and bounds and very clear on sustainable growth.
Right.
Muthoot is also growing in a very secure, safer business comparatively, because these are short-term loans. Any default, you just sell off the gold. And so you can go to what they say, less than 1% NPA level.
Right. I think absolutely. The other difference is the portfolio. The nature of portfolio is also a bit different. Bajaj is basically more diversified. They have significant, loan portfolio in mortgage-based lending, or even the corporate lending. Mahindra,
Consumer finance and personal loans also.
Yeah.
Consumer finance, personal loans.
Mahindra, is still predominantly a vehicle finance business. So I think the importance of diversification is also cannot be, overemphasized.
So Bajaj has a very clear strategy of being a kind of a financial supermarket. They could not get a bank license. In fact, they were the first to say we don't want a bank license later when the new norms came. And they have become a kind of a much more than a bank. Able to service customer, they gave the numbers also when you have got millions of customers.
No, absolutely.
So Mahindra Finance, what everybody is talking about, auto cycle picking up because of pent-up demand. Last 2 years, people have been very restrained on purchase of vehicles.
Right.
The used car market got a fillip globally, and now new cars people are looking at buying because of the pent-up demand coming. And also, if fuel price falls down, then it can give a kicker. Apparently, this is a worst state scenario of high fuel prices, where some people have been postponing their purchases because of the high operating cost.
No, absolutely. I think Manojji, next week we can take some pharma companies, some interesting trend there. So there are
Certainly.
some,
Certainly now, based on the changing dynamics, global markets, so there are some savvy investors, they are talking about return to FMCG, IT and pharma.
pharma. So next week, I can take up a few pharma results and maybe FMCG results. Ramaprasad, anything?
No, I think pretty useful. What I'm just planning is to go through some interesting results, pick out those with some qualifications, some unique notes, anything is there, so that we can understand probably some bit of auditing around that and try and enhance the.
I think it will be also interesting, Manojji, to look at some of these interesting companies which have got recently listed since last few months.
Yeah.
Like Zomato and Nykaa and all that, who have in fact apparently taken pride in widening the losses, right? Increasing the losses. So we can pick up a few results and discuss that.
Yeah. Also, the biggest trend which is happening is that in the last few fortnight, the biggest trend which is happening last 1 month, at least in Bangalore side, we have been noticing huge layoffs in all these unicorn startups. The cash burn is a big issue in startups, which is something actually a big concern now.
Especially EdTech, I think.
EdTech basically. And all these guys who have, got into a frenzy and paying double, etc., etc. And suddenly there is about 5,000, 6,000 people have been thrown out in the last 1 month. So cash burn is a big issue. So trends like that are getting visible. Maybe you are right. I think the interesting trend would be to see these startups turned IPO companies, the Zomato, the Nykaa, and the Paytm, to see what their results speak and how sustainable these businesses are without any cash generation, as against the older generation that we are pretty much used to. It really seems we have to see how the trend is in the market. And I think those are very interesting things to look. We have a lot of learnings actually out there. Yeah.
Some participants are taking up a session on startups, funding for startups, exactly what you said, including
very nice,
how to
sir.
prepare
I saw your
pitch.
Absolutely. I saw your chat, Manojji, especially interactive on startup funding, etc. I'm very happy to contribute. And, I'll share some live examples from how we are working with one or two.
That will be wonderful. And there are some requests, if possible, some of you look at international reporting, quarterly, annual, and some companies like Tesla and Facebook and Twitter, and which are those listed companies, are top 20, 25 companies listed on NASDAQ, and do deep dive into it, short deep dives, which can throw quite good insights. The way which has been covered today is excellent. We had quite a few good coverage.
No, I think that's a good idea. We can pick up a few international ones which are listed, and we can get a good view from that. Especially disclosures around this Russia and Ukraine.
Yeah.
It will be interesting to see how it has impacted reporting.
And evolving business models and evolving reporting, and some of them are quite lots of developments happening on. We have seen Twitter also. Twitter has been a change in management. The CEO has resigned last week, and the business model for funding is changing.
Likewise for Netflix also, I think they have that revenue has shrunk worldwide. They are now talking about not allowing the passwords to be shared. So today the password can be shared within 5 individuals. Right? So they are saying that it will be one user, one password. So I think that will be also interesting.
Trying to control devices, so their revenues has gone down significantly. So instead of one connection earlier for 3 devices, maybe they want more connections. But this doesn't actually really work in enhancing
Netflix,
revenue.
Amongst all, Netflix has been the most expensive, right? They have always taken pride in being the premium content provider and for a premium. they always charge a premium to the customers. So I think that they are talking about redefining that strategy.
So great work.
Okay, thank you for your participation, and thanks Manoj for your
Thank you, Manoj.
encouragement.
Very useful. Thank you for your encouragement. Thanks, Maller, Nilanjan, and every other
Thank you,
professional
everybody.
brother
Thank
who
you,
is
Nilanjan.
today.